The start of cash equity trading. I'm Tom Mackenzie, and here are your top stories. Go big or go home. Global central banks line up jumbo hikes. The Riksbank readies its biggest rate increase this century. The Fed begins its two-day meeting. Inflation headache. Japanese CPI hits a 3-decade high, piling pressure on the BOJ to justify continued stimulus. Plus, relaxing restrictions. Hong Kong weighs loosening hotel quarantine rules, easing travel for the financial hub. Asian stocks snap 5 days of decline. So some optimism in Asia, specifically in Hong Kong, on the back of that move. We're seeing some modest gains coming through in terms of the futures after that last hour trading upside for US equities. Modest gains closing out on Wall Street, and we're seeing again a little bit of that modest optimism being reflected in the futures. We'll see how things open, of course, just in the next few seconds. Here in the UK, the FTSE 100 closed yesterday, of course, for Queen Elizabeth II's funeral, opening today, gaining 0.3% in the first few seconds, up 24 points, trading at 7,261. We're looking ahead to Friday, of course, here in the UK, for what is expected to be a mini budget from the new Chancellor of the Exchequer. Over in Spain, the IBEX opening up 0.4%. That's a gain of 31 points. Of course, the focus globally on those central banks, the Riksbank at around 8:30 UK time, at least 75 basis points is expected. They could go 100 basis points. And then, of course, Fed on Wednesday, and whether they go 75 basis points, that seems to be the market view at this point, of course, and the implications then across asset classes. The CAC currently gaining 19 points, trading just above the 6,000 level. Let's switch it over, see how things are shaping up across these assets. You had a little bit of softness coming through in the US dollar. Euro is back above that 1 level, so at parity again for the single currency. Future stateside looking to gains of 0.2%, but really the catalyst will be that central bank action. And there it is, the US 2-year, 395 at the front end of the curve, very much closing in on the 4% level as that terminal rate becomes repriced. From the July meeting up until now, you've seen an increase of about 100 basis points in terms of the repricing of the terminal rate for the Fed. 395 on the 2-year. Brent, $91 a barrel, just down 0.1%. Some news out of the US around additional supplies. That strategic reserve being released by President Biden is the plan ahead of Europe, essentially blocking Russian oil by around December. Okay, let's get over to Bloomberg MLive managing editor now, Mark Cudmore. Mark, you're looking at that Fed funds rate.
Yes, Tom, indeed. Good morning. I did want to look at something else but the Fed, but it really is the dominant event this week. What is amazing is this chart that Valerie flagged to me this morning. It's Fed funds pricing from March and showing the terminal rate move since the July Fed meeting. It's the kind of thing I look at every day, and yet I hadn't quite registered the scale of the move. We've done more than 100 basis points since the July meeting. That's really, really quite phenomenal amount of tightening, given that we haven't been seeing the rate hikes in that period. We've just had hawkers speak to kind of communicate what they want to do. So over 100 basis points extra in terminal rate. Can we really get much more upside surprise this week from the Fed? I think the fact is we can, because the dots are coming through, because the forecasts are coming through. There is room for more potential upside, but certainly we've had a lot of pricing recently. Now, I want to give you one extra chart to kind of show why this is so interesting. 100 extra basis points in the terminal rate, and yet financial conditions are not as tight today as they were going into the very first Fed hike of this cycle, nor even, in fact, the second Fed hike of this cycle. They are a little bit tighter than we saw back in July and June, but still, it's very interesting. Now, it's a little bit deceptive because financial conditions, it's based on kind of changes, and obviously, it is in tight territory. We've seen financial conditions tighten recently. They've just not tightened as much recently as they had going into those prior meetings, and part of that is because money markets are reacting relatively stable, and the VIX isn't kind of running away to the top side as stocks sell off. In fact, many people have been complaining that the VIX move has stayed much more subdued than stocks, which means overall this has been a very orderly sell-off in stocks, and that's why financial conditions aren't panicking. At some point, the Fed might need to really tighten financial conditions to get on top of the inflation narrative, and that's why there is still a major threat going into this week, despite the move we've already seen in Fed funds pricing.
Yeah, that need for further tighter financial conditions. Remarkable, but they're not as tight as they were leading into the first hike. Thank you, as ever, of course, MLive Managing Editor Mark Cudmore, who also has some very strong views, by the way, on the BOJ, worth checking out on the MLive. Right, let's bring in now Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. I'm very pleased to say joining us as we kick off the central bank action in about 25 minutes' time with the Riksbank. And Peter, we're looking potentially at around 500 basis points of rate hikes from global central banks this week. Let's start with the here and now then. How do you expect global equities to react to that kind of tightening?
Well, I think that the markets are now pricing a significant tightening, as we've just been hearing. But we need to sort of put this in some perspective. It was only a little over a year ago that the markets was pricing only one, maybe two rate rises this entire year in the US. So we've traveled a long way, and over the course of that, actually, stocks haven't fallen that far yet, and financial conditions probably have got further to tighten. So I think that the risk is that as we get those greater rate rises actually delivered, the market moves to price even further rate rises over coming months, even if we don't eventually get there. So I think the key is really where the markets eventually get to pricing both rates and growth. And the mix here is probably still negative for equities, at least in the short term.
Okay, and that journey then that it continues as equities readjust to that. And in terms of valuations, Peter, you've been quite clear on this in prior conversations, saying that valuations still need to come lower as that adjustment happens. Do you hold that view then still?
Yes, I think that as you approach a trough in a bear market, and this is a bear market, what we would call a cyclical one, it's really about triggers of rising inflation and rates resulting in concerns of recession. To get to a trough, cheaper, attractive valuations are certainly one of the conditions you nearly always see. It's not the only one. Certainly, equities do start to recover during recessions when data is weak, but a slowing in that pace of weakness is usually pretty crucial, as is reaching a peak in interest rate and inflation expectations. We're in that adjustment, but valuations still, I think, have further to go. The US is still trading at a higher multiple than we've seen over the course of the long run and even over the last decade. So I think there's still vulnerability there on the valuation side before we get a trough.
And we've had, of course, earnings warnings, most recently from Ford, but also from FedEx, McDonald's and others. Do we need to brace ourselves potentially for an earnings recession, Peter?
I think the risks are certainly on the downside in terms of earnings expectations. They're still too high, largely, I think, not so much because of revenue expectations, but margins. And if we aggregate what analysts are expecting in terms of margins, both in the US and Europe, I think they're still too high for next year. But having said that, I don't expect to see a very significant downturn in profits during this next year. There are some reasons to be more positive. Private sector balance sheets are actually quite healthy. We still have reasonably solid revenues because nominal GDP is actually quite strong. And stocks are making a claim on nominal GDP. Revenues will grow with that. It's really the margin story, I think, that has yet to weaken in any meaningful way. I think that will bring earnings down, but I don't think we'll see a collapse.
Where are the relative winners in this environment?
Well, what's curious about this year is that we have finally seen a transition from a long period of outperformance of growth towards value doing better. the deeper value areas that were long neglected, that were seen as value traps as they faced uniquely difficult conditions after the financial crisis, have finally put in good earnings growth and relatively good performance, things like resources and energy, even banks. But actually, they've got relatively cheaper as investors perceive that their profits are not sustainable. We still like these deep value areas of the market, and we tend to balance that with quality defensive growth, areas of the market that have got visible recurring cash flows, solid balance sheets, and ability to compound returns over time. They're not particularly cheap, but I think in combination with deep value, you can structure a portfolio that's relatively well positioned and not too expensive.
Okay, interesting. So the call there for deep value. Peter, where does that take you in terms of your regional bias? A lot of our guests come on and saying the US is still something of a safe haven as we kind of face up to this environment of higher rates and persistent inflation. Do you align with that view, or does that deep value take you to Europe?
Well, I think it's a combination. Certainly, I think the US is perceived to be more defensive, and the dollar has been strengthening, and that means that at least in common currency terms or in dollar terms, the US is doing a lot better than other parts of the world. Having said that, some of the deep value is more prevalent, I think, outside of the US. There's a lot of very good quality growth within the US, so we like a bit of a mixture. It's clear that the US economy is less vulnerable to the current shocks than other parts of the world, particularly Europe. I think that's well understood and reflected in things like the currency. Obviously, the euro area is also lagging behind in terms of the tightening cycle. But we certainly think there are areas of the European markets which are now pricing recession quite fully, where there is decent value and a good chance of growing dividends over time. So we like to take a mix, really. And one of the themes that we've been arguing is that this year and beyond, unlike the last cycle, diversification is likely to pay off. And that means diversification across regions, across factors, and indeed across sectors as well.
Okay, so diversifying across regions, across factors and sectors. Peter Oppenheimer, always important insights. Goldman Sachs Chief Global Equity Strategist stays with us. We'll get more calls from Peter just in the next few minutes. Coming up, the Bank of Japan looks set to defy the global rate hike push. This, even as August's core inflation beats estimates. We've got more on that story, the challenge for Kuroda. That is next. This is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open. We are 13 minutes into your European trading day. You're actually seeing some pretty solid gains across the benchmark. Gains of 0.9% across the stock 600. Here in the UK, the FTSE 100 are trading at 7,308. Currently, that is a gain of 1%. Of course, the market here in the UK was closed yesterday. Futures in the US looking at gains of around 0.4%. Every single sector here in Europe is currently trading in the green, apart from real estate. Travel and leisure right at the top of the pack, gains of a little over 2%. Let's get to what's happening in terms of the central bank policy action and inflation over in Japan, though. Japan's inflation has risen at its fastest pace in more than 3 decades, excluding tax hike distortions. That creates a headache for the central bank this week as it seeks to explain why it needs to continue with monetary stimulus. For more, we are joined by Bloomberg's Japan economy editor, Paul Jackson. Paul, how does today's stronger than expected inflation reading impact this week's BOJ meeting? Then finally, they're seeing some inflation. This is what they wanted.
Yes, but it's not the inflation they wanted to see. This is cost-push inflation. It is stronger than expected today. It makes it more awkward for Governor Kuroda to explain his position, but he's probably going to stick to his guns that he needs sustainable inflation with sustainable wage gains in order to move policy. Now, of course, if you look around, global central bankers have been wrong on this all over the world. They're racing to raise rates. How can Kuroda be the only one who's got it right? But that's what he thinks. That's what he's planning to do. That's what all our economists are expecting. No change. Now, he's looking for sustainable inflation. The key question markets want to know is the BOJ's position sustainable?
Yeah, particularly as you lead up and look to the end of his term in April. So arguably part of this is a legacy issue for Kuroda as well. Currently, the yen trading at 143 to the US dollar. How much pressure, political pressure, is Kuroda and domestic pressure is Kuroda likely to come under as we look to that divergence between the BOJ, the Fed, and other major central banks, and just how extreme that is becoming?
Well, we're hearing that at the Bank of Japan that they're still comfortable with the yen where it is. They still see it as positive overall. So as long as there's no sharp slides in the yen, it could grind lower still. The BOJ will be happy. Nothing to do with them. It's up to the government to decide what to do on currency. Now, we've had the warnings, ramped up warnings and intervention threats from the government, but they haven't pulled the trigger. And I think if we grind slower on the yen, then they're not going to do anything. But if we have a sharp move, then they might step in and throw out that warning and bloody the noses of some speculators just to cool things down. And of course, looking at it, we're going to have all these rate hikes this week, sorry. And if the BOJ stands pat, it's going to be the only bank with a negative interest rate. It's going to be looking very isolated. So that's going to be looking good for those yen bears.
Yeah, indeed. I don't blame you for talking about a year. It does feel like a year in terms of the sheer number of central bank decisions that we've got this week. Paul Jackson, thank you very much indeed on the latest in terms of the pressure on the BOJ amid that higher inflation. Let's bring back Peter Oppenheimer, then Goldman Sachs Chief Global Equity Strategist. Peter, I want to get your views on Japan and the BOJ, that divergence as we were talking about with Paul there. Mark Cudmore from our MLive team says that this could be the next big market risk, is the BOJ being forced to capitulate and move away from its yield curve control at some point in the months ahead. Do you see that as a significant risk for these markets?
Well, I think it is because of the growing pressures that we have, both of the dollar rising and, of course, other central banks being forced effectively to capitulate and tighten policy to control inflation. So obviously the pressures will continue to build. And again, I guess the concern is that investors start to worry that will lead to, a more significant shift in policy in Japan. We do actually have the yen strengthening on our forecasts over the course of the next year, amidst a modest weakening in the dollar as you get towards sort of global peak interest rates. But I think that, there is going to be increased focus on Japan and its approach, both from the Bank of Japan and also the government, as you say.
On the dollar, Peter, just because you brought it up, in terms you're starting to see some modest weakness, what is the kind of time frame that you're looking at for when the dollar starts to turn?
Well, it's really over the sort of next 6 to 12 months, and we're not looking at significant moves here. But clearly, on many measures, and this has been true for a long time, the dollar is expensive in terms of purchasing power, parity against other currencies. But interest rate differentials, global uncertainties, and indeed the more advanced approach to raising rates in the US vis-a-vis other areas have all overwhelmed that. But as we get towards a peak in global inflation and interest rates, and we start to move out of this economic downturn and hopefully risk moderate, we would expect the dollar to soften a little bit against other major currencies.
Okay, and that's a kind of 6 month to 12-month view. Peter, what are you looking for from the Fed on Wednesday and Thursday? 75 seems to be being baked in now by these markets. So the commentary from Jay Powell, the dot plots, what is going to be drawing your focus in particular?
Well, very much the commentary. We are expecting 75, and as you say, that's what the market is pricing. We're looking at 50 and then 50 in the two meetings that follow that. So getting to a sort of terminal rate of 4 to 4.25, which again now is pretty much what the market is pricing. But any guidance will be much, I think, followed, and people will very much read in to the nuance of the commentary in terms of an indication on how happy they are with the progress in interest rates and inflation, what they think is happening to the labour market, importantly, as well, and indeed to financial conditions. So there will be, of course, a lot of focus, not just on the move itself, but on the message that accompanies it.
Okay, the importance of the commentary from Jay Powell later this week. Peter Oppenheimer, always insightful. Thank you. Goldman Sachs, Chief Global Equity Strategist on everything from the Fed to what's happening here in Europe and, of course, the BOJ and the pressure on Kuroda. Thank you. Coming up, rate hikes in play then as the Fed begins its two-day meeting. Sweden's Riksbank kicks off that avalanche of central bank decisions this week with an expected 75 basis point increase. We will get that announcement in about 10 minutes' time and bring it to you live. Stay with us for that. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
One way for the governments and the central banks to go is to focus more on production. How do you get more things out in the economy? And that makes it it means that you won't have to do as many rate hikes. They have been less eager to really stimulate this time. That may be good for their economy and good for the long run, but it means for the world, you've got the number 2 economy that's not really right, jumping forward. That puts more burden on the U.S.
World Bank President David Malpass there giving his thoughts on how to cool inflation and that lack of very aggressive stimulus that has yet to come through from China. Let's check in then on the markets 24 minutes into the trading session here in Europe. You're seeing gains of 0.9%. Here in the UK, you're looking at gains of more than 1% after the holiday yesterday, at least the marking of the funeral, of course, of Queen Elizabeth II. The FTSE 100 reopening today. The CAC currently is getting 0.8%. Over in Germany, gains of close to 1% as well. Autos, top of the list across your sectors, gains of almost 2%, followed by banks, travel and leisure. Just one sector in the red at this point, down 0.8% is real estate. S&P E-minis, the futures in the US, looking to gains of around 0.4% as well. We'll have the Riksbank decision very shortly, in a little under 5 minutes' time. Bring that to you as it kicks off the central bank action. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Ford shares have tumbled in late trading after warning supply costs are running $1 billion above expectations in the current quarter. The US carmaker reaffirmed full-year earnings guidance, but signaled shortages of key parts will keep its inventory of half-completed vehicles elevated. The US is to release 10 million barrels of crude from its reserves ahead of the EU's ban on most Russian imports, which comes into force in December. It comes as global oil prices retreat to levels seen before Russia's Ukraine invasion, and with OPEC discussing possible production cuts. American Express says it's planning to add 1,500 employees to its technology arm. The card company has told Bloomberg that roughly 60% of the hires will be in the US, with about a third in India and the rest in Europe. Amex has already added over 3,600 tech workers this year as a surge in post-pandemic revenue allows for new investments. That's the Bloomberg Business Flash. Tom.
Laura, here in London, thank you very much indeed. Okay, coming up, Hong Kong is looking to relax COVID curbs and reconnect with the rest of the world after 3 years of quarantine. It's good news, of course, for the international community there, and of course the Hong Kong business community. On the back of that news, you've seen gains in Hong Kong stocks as they digest investors, potentially a softened stance when it comes to quarantines. Hotel quarantines may be scrapped. Plenty more coming up. Stay with us. This is Bloomberg.
the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Go big or go home. Global central banks line up jumbo hikes. The Riksbank decision hitting any second now. The Fed begins its two-day meeting. Inflation headache. Japanese CPI hits a 3-decade high, piling pressure on the BOJ to justify continued stimulus. Plus, relaxing restrictions. Hong Kong weighs loosening hotel quarantine rules, easing travel for the financial hub. Asian stocks snap 5 days of declines, and certainly that was one of the catalysts. Here's the red head then. Across the terminal, the Riksbank has hiked. It's currently hiked its benchmark policy rate to 1.75%. That is a bigger hike than many market participants and economists had expected. The estimate had been to move that benchmark up to 1.5%. They've gone bigger. They've gone to 1.75%. That is the Riksbank coming out with a bigger than expected hike. I'm just going to check. Currently, the krona gaining 0.5%. So a 0.5% move against the single currency, against the euro, on the back of that news. This is the biggest hike then for the Riksbank of Sweden. A full 1 percentage point since for about 3 decades. It is the only second of the big G10 FX countries after Canada to hike by 100 basis points, by a full 1 percentage point. And this may well add pressure, at least speculation, that the Fed will go bigger than 75 on Wednesday. Concerns about the housing market, certainly in Sweden, whether this tips things into something of a housing market crisis. But on the flip side of that, inflation running at 9% has clearly been the key factor behind this decision. Again, the markets had expected the benchmark to be increased to 1.5%. It was, in fact, increased to 1.75%. The Riksbank, just a couple of additional lines coming through. Asset purchases are expected to cease at the end of the year. They will continue the asset buys in accordance with the June decision. And here's another redhead. The Riksbank rate will be raised further in the coming 6 months. So the Central Bank of Sweden hiking bigger than expected and flagging further rate rises in the coming 6 months. Gains of 0.5% for the Swedish krona against the euro. Let's bring in Christina Kino from Bloomberg Market team, of course, for reaction to this. So they went big, and they went bigger than many had expected.
Absolutely, Tom. And this really is the name of the game, it seems like, among G10 central banks this time around, is really focusing on those bigger than expected rate hikes and providing that shock value to markets. I mean, 100 basis points from a developed market central bank. I mean, this sort of rate hike, even just a few months ago, you really would only see that from an emerging market. But we've come such a long way in just a short span of time. I think a lot of that is, of course, added pressure from the even bigger central banks, the Fed primarily, really again entertaining that idea of another 75 basis point rate hike, potentially 100 basis point rate hike. And you would expect these smaller nations with more open economies to follow suit.
Do you expect markets to start to price in an even bigger hike from the Fed? 75 basis points up until this decision had been consensus, essentially, for the Fed on Wednesday.
Yeah, absolutely, Tom. I mean, this is the nature of markets, right? Is to kind of overprice something, especially heading into a big event such as the Fed. And so I would expect over the next couple of days, definitely keep an eye on that pricing specifically for this week, but also more importantly, the trajectory of where the Fed rate is going to be over the next few months. I mean, we have already seen that peak terminal Fed rate being priced at 4.5% sometime in the first quarter of next year. And of course, what's interesting is what markets expect to happen after that. According to market pricing, that rate is going to sharply fall off by about 100 basis points over the year starting from the first quarter of 2023.
And that's where you get the Luke of Jupiter Asset Management saying there's an opportunity at the longer end of the curve to start buying at this point because you're not going to get the soft landing and therefore the long end is looking attractive at these levels. Talking of which, there is now a sell-off, particularly in gilts. You're seeing moves of about between 5 to 7 basis points on 2s and 10s here in the UK. Also a sell-off in German debt. US 2-year currently at 3.95. Not much of a move there at the front end, 3.95 on the US 2. You've been talking and thinking about the BOE as well. I mentioned gilts and yields up on the back of this decision. The BOE under pressure to go higher as well, despite concerns about plunging this economy into a deep recession.
Absolutely, Tom. I think it is quite an interesting time for the BOE. Of course, that meeting was delayed by about a week because of the Queen's funeral and the period of mourning. But even now, you know, at this point in time, I think it's an even more interesting time because we have seen now the ECB deliver that jumbo rate hike, the Fed potentially delivering that jumbo rate hike right before the BOE is set to meet. And so they will be under pressure to kind of follow suit. The market's again expecting multiple jumbo rate hikes from them by the end of this year. And you can see how much pressure it's under. And then when you consider, of course, the other side of the story, which is that they are having to manage an economy going through a cost of living crisis, an energy crisis heading into the winter time. It really is quite a tough job to be managing the inflation side of it while at the same time looking at such dismal growth numbers in the UK.
Another 75 for the ECB as well, given the moves that we saw a couple of weeks ago?
That's certainly in the cards as far as market pricing is concerned. Of course, the big question is whether policymakers will allude to that or will succumb to that. I mean, we have seen some indications after the last ECB meeting that policymakers are open to that idea. And yeah, it really is astounding how much the conversation has changed with regard to both the ECB and potentially the BOE. I mean, again, this idea of even just starting the process of hiking rates wasn't even on the table for the ECB up until a few months ago. But here we are, again, talking about the possibility of even more before the end of the year.
Yeah, and I didn't even have time to talk BOJ with you. Of course, we did get an update on that, but it puts the BOJ and corridor even further outside the central spectrum of central banks, doesn't it? Alongside the PBOC, arguably. Bloomberg's Christina Kino, fantastic to get your reaction, of course, to that Riksbank going big with 100 basis points, and of course, looking at all the other central bank action as well this week and going forward. Thank you. Okay, that's now China Morning Post. Let's switch focus to what's happening in Hong Kong now. The SCMP reporting that Hong Kong's government has agreed to adjust its mandatory hotel quarantine for arrivals to the city. For more on this, we're joined by Bloomberg's Michelle Cortez. Michelle, Hong Kong then finally seems to be stepping closer to opening back up after a lot of pressure from the business community there. What is the latest?
At this point, we're looking at when, not if. We are expecting that the government is going to get rid of the hotel quarantine, which has really put a damper on any visits to Hong Kong, whether it's from businesses or family members, people who want to visit. It has been exceedingly difficult to get in here for the last almost 3 years. And so now we are going to see that come down. We're expecting that there's going to be some type of a restriction where people will have to monitor themselves at home, that there's a health app where people perhaps won't be able to go to bars and restaurants quite as freely. We're still not entirely sure on that. There's also questions about whether people will have to take PCR tests before they get on a plane, or if that's going to go out the window as well. The timing is when. We're thinking end of the month, but that is still also a bit up in the air.
It's quite a pivot, isn't it? Because I remember under Carrie Lam, of course, the former chief executive of Hong Kong, the priority was opening that border between Hong Kong and the mainland. And of course, the impression was that Beijing was pressuring Hong Kong to take this very rigid approach to COVID control. What has changed? How has Lee gotten away with this? And does he have the backing of mainland authorities?
It's such a great question. There really does seem to have been a pretty fundamental shift happening in Beijing at this point. Perhaps it's because they're realizing how big of a hit Hong Kong has been taking because of these curbs, and seeing other places like Singapore, for example, basically cut into Hong Kong's business. But there has been a shift there. We are hearing that Beijing seems to be on board with these moves. Perhaps they've been wondering what's been taking Hong Kong so long at this point. To begin with, at this point, it is very puzzling because there has been concern in the past that some of the Hong Kong's earlier outbreaks, specifically the one this spring, might have seeded some of the infections that happened in China, which is still maintaining a COVID-0 approach. But we are hearing that Beijing is on board with this, that they are looking at this point to support Hong Kong in its measures to reopen. Not only that, Lee has proposed other measures that would allow people to move more freely from Hong Kong into China. So there is an entire shift happening underway here. All the pieces are still moving at this point, but a month, 2 months from now, we're thinking it's going to be very different here in Hong Kong.
Very, very interesting. Of course, good news for you and the team as well. Thank you, Bloomberg's Michelle Cortez, for the latest on the plans there by Hong Kong to reduce those quarantine requirements. Coming up, markets are jittery, of course, ahead of the Fed's big expected move midweek. Tomorrow, we dive deeper on what to watch in terms of the commodities market then, the implications, the layover, the crossover at least, from central bank policy tightening to the commodity market. We'll get all the insights from BlackRock. Stay with us. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
From the world of politics to the world of business. Balance of Power with David Weston. Views, analysis, insight from and about politics' power players. Weekdays, this is Bloomberg.
Welcome back to the Open, 42 minutes into the European trading day, and the gains that you saw in the first 30 minutes of this trading session being paired quite significantly. You're seeing gains now just 0.1% across the benchmark, having been up almost 0.9% just a few minutes ago. The Riksbank coming out with a bigger than expected hike of 100 basis points, the Swedish bank, following the Bank of Canada, just two now major G10 countries coming out with basis point increases of 100 basis points or 1%. The Fed, of course, up on Wednesday. The BOE on Thursday. Futures in the US have paired those gains as well, range-bound now for the S&P E-minis and the NASDAQ futures as well. It's a very mixed picture across your sectors. Banks still holding on to gains here in Europe of a little over 1%. Jerome Powell, of course, taking centre stage for commodities this week, with the Federal Reserve Chief set to unleash another large rate hike that could pile more pressure on energy, metals and crops, as I mentioned, of course, following that jumbo hike from the Riksbank. Very pleased to say we are joined now by Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock. And Evie, I have to just get your views, broad views on what's happening across commodity market pricing. The Bloomberg Commodity Index was up about 40% year-to-date up until June, and then there's been something of a correction, pulled off about 14% since then. If you overlay the central bank action that we're seeing, the Riksbank surprising the markets this morning, the Fed tomorrow, BOE on Thursday, and a number of others, can we call an end to the rally that we saw at the front end of this year when it comes to commodities?
Yeah, it's a great question, and it's the question we've been asking ourselves. It's the questions that our clients are also asking us as well. So I think if we break it down into the traditional way of looking at commodities, it's obviously demand and supply. So when you look at the demand side, you've had the fears around recession in Europe, you've had interest rates rising, but you've also had significant demand reduction in China, which is the biggest commodities consuming nation in the world. And the COVID-related uncertainty that has slowed down the growth in that economy has had a material impact, probably in the short term, with regards to commodities. But when you look across the commodity deck, you still see that supply-side tightness, across pretty much every commodity we can think of. So if you look at things like copper, you look at the energy markets, etc., that tightness has kept commodity prices at elevated levels relative to where you might think that they would fall to, given the interest rate moves and the fears around recession. So actually, I think the commodity markets right now are kind of bubbling away. Very, very exciting. We've got huge potential to the upside and probably limited potential to the downside. And that kind of skew of returns as we go into the autumn, which is always a pickup in commodities demand for the world after the kind of traditional Northern Hemisphere summer period and holidays and so on, that could actually be very exciting for many investors in this space. What we've seen in the equity market is actually even more significant. You mentioned a reduction in the Bloomberg Commodity Index. You've seen a much bigger fall in commodity equity valuations. So, but the companies don't have anything like the risk factors that they used to have, like high levels of leverage and so on. So, the bounce back potential, if we do see a move in commodity prices, how that will be reflected in equities could be even more exciting.
Okay, that's really fascinating, and there's a lot to unpack. What triggers that move higher in commodity prices?
Well, I think
is it just China coming back, or is it more than that?
You have to pick them off one by one. Okay. So the first one clearly is China. If we start to get to resolution with regards to COVID policy in China and a move back to more normal economic activity, we start to see the stimulus measures that China's been putting in place actually flowing through into economic activity. That will result in a big pickup in commodities demand. So I think that is your kind of first one that you need to get clarity on. Secondly, obviously, we need to get to the bottom of the interest rate cycle. When we start to see those rises coming through and they start to see them flattening off, that'll be something that we're looking for probably next year, or maybe even longer into the future. But the fact that commodity markets are so tight at a time when you do have this commodity weakness that we've seen in terms of demand, and say in Europe and also in China, bodes very, very well for when demand does start to come back.
You're actually seeing resilience there. And how much of that is down to a lack of investment? Is that investment, are those investment flows starting to come back in?
Yeah, that's been the key point over the last probably 6 years. And we've seen this play out in many cycles in the past. When you have long periods of underinvestment into new supply, and then you have demand coming along, there isn't enough capacity in the system to absorb that positive demand shock. You know, that's exactly what we're seeing today. Inventories are incredibly low. We haven't seen the investment in the supply side. So when that demand does come back, you're going to see a very powerful response in terms of commodity prices.
Europe continuing to readjust to the energy crisis it's facing and having to, of course, adjust to the lack of supply from Russia in terms of LNG. We're seeing the Germans adding another 2.5 billion euros to their ability to purchase additional energy supplies. And then energy price caps being put in place in a number of countries. The readjustments in the European energy market, what do you see as the longer-term consequences if you look out 5, 10 years for the kind of actions we're seeing put in place, the kind of policies we're seeing put in place on the continent, indeed here in the UK?
Yeah, so I think there are a couple of things within that question. The first one is obviously when you have an imbalance between supply and demand, and in this case, we've seen that reflected in higher prices for energy. Normally what you would see is demand response. But when we've got the energy caps being put into place, that's actually not going to let that demand response come in the traditional way that it would do. So I think that's actually quite scary with regards to demand for the future. And as a result, we need to see more investment with regards to the energy transition. And this is a big theme that we've been talking around at BlackRock. You know, we're seeing hundreds of billions of dollars, if not, $1 trillion+ being invested in this energy transition between now and say 2030 or just beyond. Huge investments in renewables, storage, potentially down into hydrogen. The evolution of the economy away from carbon-intensive, fossil fuel-generated power into alternatives is going to be one of the most profound things we've seen in the global economy going back for hundreds of years. And doing that at scale and at speed is incredibly complex.
And so as an investor looking to align your investments with that policy shift, what should be top of mind?
Well, there's a number of things that we should be thinking about. What are the technologies that are going to benefit from this? What are the applications that are going to see demand response because they're going to see a higher involvement of those technologies into the economy? So you think about all the renewable investments that need to take place, the battery storage, the connectivity, electric vehicles. This is a massive, massive transition for the global economy. And secondly, you can't do that without commodities. And that brings us back to the kind of first part of this interview is, we're going to see this prolonged period of higher than expected commodities demand growth that's going to be with us for many years into the future, and we haven't seen the supply-side investment to accommodate that. And if we don't see that supply-side investment soon, prices are going to reflect.
Evie, before we let you go, if you were to pick a commodity at this point that you'd want to be getting exposure to, copper, oil, gold, or indeed part of the equity markets, whether it's producers or refiners, where would you be tended to focus?
Yeah, I think there's obviously two very different investments there. On the commodity side, you're just going to see a move in the commodity. So Bloomberg Commodity Index, for example, that would give you a general exposure to an uplift in commodity prices from here. On the equity side, you're seeing companies pay fabulous dividends. We're seeing dividend yields of 5 to 10%. So you're getting paid whilst you wait. You're also seeing the risk in those businesses very, very low today because of the absence of debt, which we've seen in every cycle in the past that's caused the equity prices to have those dramatic falls. That just doesn't exist anymore. So you're being paid whilst you wait, and you don't have the risk, and you've got that potential upside. So we are very excited, and that's where we're deploying risk in our portfolios.
Fantastic. Thank you very much indeed. Always excellent to get Evie Hambro's insights into the world of commodities and some of the themes as well to be looking at. Evie Hambro, of course, Global Head of Thematic and Sector Investing at BlackRock. Coming up, a luxury unraveling. A Chinese LVMH wannabe spent billions buying up global luxury fashion brands, but it's now seeing a messy unwind. That is today's big take. It's up next. We'll unpack it for you, all the juicy details. Stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back to the Open. 54 minutes into your European trading day. Paired some of the gains that we saw in the early part of the session, just up a little over 0.1% across the European benchmark. Flat on your futures stateside, a little downside in terms of NASDAQ futures as well. Riksbank coming out with a 100 basis point move, bigger than many market participants had expected. Now, 6 years ago, a little-known textile maker called Shandong Ruyi Group embarked on a frantic acquisition spree with the ambition of becoming China's version of luxury powerhouse LVMH. But since then, its ambitions have quickly started to unravel. The story of that unraveling is the subject of today's Bloomberg Big Take, and it is a fantastic read. Here to tell us more is the writer of the piece, Bloomberg's Manuel Baigorri. Manuel, how did it all come crashing down then for this company?
Tom, you know it very well. I mean, there was a massive push from China years ago to expand abroad, and some companies embarked on a massive acquisition spree. Take H&A, take Ambang, and of course, as you mentioned, Shandong Ruyi, the piece of our story. I mean, they bought a lot of luxury assets in Europe, particularly in Paris and in London, and they took on a lot of debt. They spent in total about $3 billion snapping up assets. And then they were faced by the pandemic. They faced a lot of challenges integrating those businesses, and the economic slowdown really put the brakes on a lot of those businesses. And now the problem is they need to repay the debt. They are having a lot of trouble doing it, and they're facing a lot of disputes from the creditors. So we are in a situation in which they are forced to be selling some of those trophy assets.
Yeah, and you have this description of the CEO holed up in a hotel in Hong Kong where you are trying to manage this unraveling. What is next then for the group?
I think for now, there is two things, right? For now, they need to face those disputes from the creditors. A lot of people trying to get the money back, and they are also being faced by selling those assets and turning them around at the same time. So they need to try to improve the operations of those businesses amid a very, very difficult backdrop with the economic slowdown.
Okay, Bloomberg's Manuel Baigorri, thank you for joining us out of Hong Kong. If you want to read Manuel's piece, I recommend you do. Type in NI Big Take, go into your terminal, or log on to Bloomberg.com. We will leave you with a market check just before we go then. As we close out the European market open, you are seeing now across the European benchmark just very slim gains, clinging on to gains of 0.1%. Futures in the US, though, have turned into the red. The Riksbank coming through with a 100 basis point move. The Swedish central bank setting the line ahead of the Fed and the BOE. Stay with us. This is Bloomberg.
started, I had no idea it was going to turn into this. It's a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, and building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We have even more conviction in the need to be defensive at the moment, so I understand a bit the fact that risk asset today and in the coming days may remain under pressure.
One way for the governments and the central banks to go is to focus more on production. How do you get more things out in the economy? And that makes it it means that you won't have to do as many rate hikes.
While we will do our best to control the epidemic, we aim to have the maximum connection with the international world and also to reduce the inconvenience to people who arrives at Hong Kong.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York, looking at UNGA with the first trip of Liz Truss. Here's what's coming up on today's program. Go big or go home. Global central banks line up jumbo hikes. The Riksbank surprises with a 100 basis point rate increase. The Fed begins its two-day meeting. Inflation headache. Japanese CPI hits a 3-decade high, piling pressure on the BOJ to justify continued stimulus. Plus, relaxing restrictions. Hong Kong weighs loosening hotel quarantine rules, easing travel for the financial hub. Now, we have quite a lot going on, of course, here in the UNGA. This is General Assembly, where we have heads of state starting to arrive either late last night or this morning. We'll follow especially what Liz Truss will do on her first real working week after the morning of Queen Elizabeth II. European stocks actually following peers in Asia higher after an 11th hour rebound on Wall Street. That seems to indicate that traders are really coming to terms with another jumbo Fed hike, but had priced out expectations for a bigger surprise. The dollar pretty much little changed. In terms of what we're seeing overall, a look at for currencies, the U.S. Central Bank does kick off its meeting today. It's expected once again to hike rates by 75 basis points on Wednesday. Signal rates, of course, are heading above 4%, and then it will pause. If we have something different, we could see a big change on where the markets price in further hikes. In terms of what we're seeing in Europe, again, the big one to watch out for is Italy. They have elections on Sunday. No matter who wins, and we think it's a center-right coalition, we'll have questions about the budget, and we'll have questions on what and how BTPs take it. So it is a big week, as you know, for global monetary policy. Central banks around the world are forecast to deliver rate hikes, adding up to more than 500 basis points combined, with the potential for an ever bigger tally. Well, Sweden's Riksbank kicked off things earlier this morning. The U.S. will follow tomorrow. We're joined by Miles Bradshaw, head of global aggregate bonds at JP Morgan Asset Management. Miles, thank you so much for joining us. We're also joined by Christina Keene, of course, our NLive editor. So, Miles, thank you for joining us. Where is the smart money going this morning?
I think the smart money is really to anticipate central banks to be more hawkish. We've seen it from the Riksbank today. We've had a story of inflation being too persistent. We've had a story, despite slower economic growth, the labor market being very strong. You know, if you saw the decline in jobless claims in the US last week, central banks know rates aren't in the right place. The question is, why delay getting there faster? So I think the smart money is to bet on them being more hawkish than markets expect. Wouldn't be surprised if the Fed were to raise rates 100 basis points tomorrow.
Yeah, so Christine, first of all, do you agree with that? And we've seen, of course, a move in Treasury 2-year yield. Where do they end up?
Absolutely, Francine. I think, you know, as Maz was saying, the smart money really recognizes that the central banks need to do more to curtail this rising inflation, even at the expense of potential growth slowdown down the line. And, you know, when it comes to that 2-year yield in the U.S., I mean, I think we're looking at pretty much toward the 4% level at this rate, which is quite astounding, because just a few months ago, 3% seemed to be the ceiling. But, you know, it only took a few months to change that story. But I think more broadly as well, where those yields end up and where market pricing ends up really will depend a lot on where markets gauge the terminal rate to be. At the moment, I think markets are pricing for that to be at 4.5% at the first quarter of 2023, and then quite a sharp pullback from that level by about 100 basis points over the next year after that.
So, Miles, if we get 100 basis points, what happens to the markets? It's not priced in. I know in certain parts of the market, maybe we could start a repricing for that jumbo hike.
I think, well, it's clear what happens is interest rates go up, particularly at the front end of the yield curve, and risk markets would be shocked by that, and you'd expect a decline in the stock market and a stronger dollar. But I think Christine makes an important point. I think for the Fed, the key thing is that they need to keep rates restrictive for some time to squeeze out inflation. So the other thing, perhaps with more detail, is what they do with the dot plot. And I would expect their dot plot to be signaling, as they've already told us, but to really reinforce the message, then they're not anticipating a pivot in a quick reaction to a falling stock market, for example. So expect to see those dot plots reinforcing the idea that rates are going to be high for a prolonged period of time, and this means for more than the 6 months that are priced, but more like a year.
Miles, will we see the same actually then from Bank of England and ECB?
The Bank of England is a bit more complicated. Partly because obviously you've got a fiscal package that's going to be announced on Friday. But I think, again, if I was at the Bank of England, we know that we're going to get an easing of fiscal policy from the government, and that's going to be quite a substantial easing of fiscal policy. Rates are not in the right place. Again, the incentive, to my mind, is to get going faster towards that, call it neutral level, so that you're able to be restrictive in a more nimble rather than dramatic way by raising rates at 25 or 50 basis points as the incoming data comes in. So I would expect 75 basis points from the Bank of England on Thursday. But being a committee of 9 members, it's much more difficult to predict how individuals will actually vote and will have the majority.
Christine, what are you expecting for the Bank of England? I know there's been, you know, traders pricing in 2 3/4 points of hikes by year end.
Absolutely, Francine. That's definitely the direction that investors want to push the Bank of England towards. But yeah, like Miles says, I think the Bank of England is in a bit of a unique, difficult position at the moment, just because, you know, the inflation story is one side of the equation that they need to handle, but then they're also being confronted by a very real and very imminent cost of living crisis and an energy crisis heading into the winter time. I mean, if, you know, they wanted to be cautious, 50 basis points seemed like the sensible way to go even just a couple of weeks ago. But after the ECB delivered their jumbo rate hike and potentially the Fed and the BOE is going to be coming after both of those central banks, the pressure is definitely going to be on for them to either follow suit or at least, if they go by 50 this time around, signal very clearly that they're open to more and bigger rate hikes down the line.
Thank you both for joining us. Christina Keener and Miles Bradshaw from JP Morgan Asset Management stays with us. Coming up, the Bank of Japan is set to become the world's last negative rate holdout, despite record high inflation. That story is up next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
They have been less eager to really stimulate this time. That may be good for their economy and good for the long run, but it means for the world you've got the #2 economy that's not really jumping forward. That puts more burden on the U.S. One way for the governments and the central banks to go is to focus more on production. How do you get more things out in the economy? And that makes it it means that you won't have to do as many rate hikes.
World Bank President David Malpass there giving his thoughts to Bloomberg on the inflation problem. Now, Japan's inflation has risen at the fastest pace in more than 3 decades, excluding tax hike distortions. That creates headaches for the central bank this week as it seeks to explain why it needs to continue with monetary stimulus. Well, still with us, Miles Bradshaw. He's head of global aggregate bonds at JP Morgan Asset Management. Miles, I don't know whether you want to call Japan the great experiment, or actually, I really don't know how they get out of this.
Yeah, and ultimately, the longer they keep policy neutral, or keep policy interest rates at where they are, the weaker the yen is going to be, and the greater the extent of imported inflation, and the greater the likelihood is that inflation expectations go up, which, let's face it, that's what they've been trying to achieve for 3 decades. So you could actually say that is actually a successful outcome. As an investor, though, I think the longer they keep policy where it is, the more likely it is that they actually abandon yield curve control. And so it's now is the time to be thinking about strategies that benefit from them abandoning yield curve control, knowing that actually it may not come at this meeting this week, but most likely I think you're going to start to see, whether it be leaks, whether it be conversations with analysts, discussion about how they actually abandon yield curve control, whether they move the target, which I think is less likely, or whether they actually start to bring the yield curve control target down the yield curve, and so gradually come off the market manipulation rates.
But Miles, so why have we not had it so far? I know we heard from Governor Kuroda that to a large extent he hasn't done much because he thinks any effort will be futile.
Yeah, because I think Japan is in a different place in terms of its inflation, and particularly inflation expectations. I mean, let's face it, you've had the highest level of inflation, as you said, for about 3 decades, and it's coming with, less than 3% on core inflation. US core inflation is running at 6%. So I think the different inflation dynamics do justify the Bank of Japan to be the last out of the gates in terms of raising rates. And it is an economy where inflation expectations are for 0 or deflation, as opposed to the US and Europe, where they're around 2%, a bit above 2%. So they are in a different place, but ultimately it doesn't seem that that's sustainable, that policy.
Right, and as you say, it's not sustainable given this economic backdrop. Do you see Governor Kuroda capitulating, or at least changing, only when we see, sustainable wage growth?
Yes, and his term is coming up next year, so it may be that he hands over and he can sort of say that he's actually achieved his objectives, and someone else has to do the job of how do you actually return interest rates in Japan to a level that's set by the market. I wouldn't be surprised if actually he sees out his term by actually declaring victory over deflation.
Okay, so given the picture, we talked about BOE, we talked about the Fed, where do you see the main opportunity, Miles, in fixed income?
Well, I think we shouldn't forget valuations. You know, higher rates, that's the market creating value. As central banks who have been manipulating markets for decades in order to achieve, let's face it, quite justifiable, reasonable economic outcomes, as they withdraw from markets, it creates value. So I think investors shouldn't lose sight of that. Higher yields should bring more capital into the bond market. I don't think rates are yet at a level that you would call cheap. So I think for the time being, it's about positioning on the yield curve, being underweight the front end. It's about looking for relative value opportunities. In particular, we haven't talked about China, but the Chinese economy is in a different place. It's about looking at opportunities in emerging local markets where rates have already gone up and where bond yields are now arguably cheap. So relative value opportunities and keeping capital available to exploit any sell-off in markets and an overshoot in terms
Miles,
of valuation.
So you like China, and you've laid it out quite clearly. You like China, you like also emerging market local rates. This is despite recession risks or because of recession risks?
Because of recession risks. I think in places like China, the recession risks are elevated. The reopening could be a temporary short-term relief, but China's dealing with a housing market that is deleveraging, and best way out of that is to ease macro policy. Youth unemployment is at a very high level, so there is going to be a need to ease policy in China, whereas we're talking about the US and in Europe a need to be raising rates to create a recession. So very different markets there. And I think as a global bond investor, you want to be allocating your capital that diversifies your risk, so it gives you better returns over the longer term.
And Miles, I know you're looking at Mexico. What do you do with Brazil that has a whole other set of economic concerns?
Well, obviously the big issue in Brazil is the election coming up. But I think Brazil is in a similar position where rates have gone up sharply, growth is slowing, and that will bring down inflation with time. So you've got to, I think, be looking at it from that perspective. Same with Central and Eastern Europe, where rates have gone up a lot, growth is slowing. That's going to be more successful in terms of lowering inflation than perhaps you have in economies such as Japan we've discussed, which are behind the curve in terms of raising rates.
Miles, also Italy is going through elections on Sunday. It's quite incredible that actually the spread also between German Bunds and BTPs has not been wider. Is the market prepared for anything, or are they just hoping for the best?
I think the market is expecting the far right to take power, and the far right has come in saying they will abide by the EU fiscal rules. So the market is not so worried about election risk. We're not facing the prospect of Italy leaving the euro and a sort of breakdown of communications there. I think the challenges are going to emerge, as you were discussing, when they actually have to present their fiscal plans. So I think the risks are that as time goes, we see that Italy actually has more fiscal slippage than we expected from the previous government. But that will come from when they present their budget details.
Yeah,
and that will be obviously wider for spreads.
Yeah, and that of course depends on whether they stick to the reforms to get that tranche of money from the EU. Speaking of the EU, if you're the ECB right now and you're looking at these higher energy prices, is it one of the most difficult jobs in the world when it comes to central banks, or is it parallel to the challenges of the Bank of England?
I think it's parallel to the challenges of the Bank of England. Is how do you deal with stagflation? You know, you've got high inflation, whether it be energy prices, wages, and actually you've got a forecast, very weak forecast for growth. And you're not sure how your models work. Over the last 25, 30 years, growth has led inflation, but you're seeing inflation driven by a lack of supply rather than a excessive demand. So you're not clear to the extent you need a recession in order to slow inflation, coupled with the fact that the COVID reopening has seen a big bounce back in economies. It's not easy to extrapolate market trends and economic trends in terms of your models. So I think it's the issue of how do you deal with stagnation that is the key challenge really here.
Miles, thank you so much. As always, Miles Bradshaw, their head of global aggregate bonds at JP Morgan Asset Management. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Hong Kong's chief executive says he wants to relax the COVID measures that have made travel to and from the city difficult for nearly 3 years. John Lee says officials are actively studying new quarantine arrangements with a decision due soon. The South China Morning Post reports Hong Kongers to ditch hotel quarantine, swapping it for 7-day home monitoring. Now, Liz Truss says a trade deal between Britain and the US is unlikely in the short to medium term. The UK Prime Minister says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting of the UN General Assembly. The US is to release 10 million barrels of crude from its reserve ahead of the EU's ban on most Russian imports, which comes into force in December. It comes as global oil prices retreat to levels seen before Russia's invasion of Ukraine, and with OPEC discussing possible production cuts. Ukraine's foreign minister is calling for more weapons from the West as it presses ahead with its counteroffensive against Russian forces. He told Bloomberg Ukraine wants to add to its recent territorial gains, denying Russia any strategic advantage.
Sometimes I'm being asked whether there is enough of weapons that we have received, and I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
Separately, Liz Truss is reported to be planning to match this year's military aid to Ukraine in 2023. The UK Prime Minister will make the pledge to the UN General Assembly this week in her first foreign trip since taking over. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We are here, of course, in New York, following Liz Truss on her first trip abroad, amongst other things. Now, coming up, sustainability in the fashion industry. We hear from British Vogue's editor-in-chief, Edward Enninful. That's coming up next, and this is Bloomberg.
All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
I remember a few years ago, I put Taylor Swift on the cover, and the byline was "Buy better, buy less," and it was a radical concept at the time. But now we all talk about sustainability. We know we can't keep shopping every day. We know we have to buy things that last, things that help the planet, things that we can pass on to sort of other generations. So I think that really is a conversation that the fashion industry is having right now that I find so exciting. And it's going to be sort of, people are going to have less money, so they have to buy things that last.
That is the British Vogue editor-in-chief, Edward Enninful, speaking to me. Of course, you can watch that full interview for our From the Ground Up series on Bloomberg UK website from 11 a.m. today. Now we talk sustainability, diversity, and the future of fashion. In the meantime, the market's actually pushing higher. What we look at is that Fed jumbo hike being priced in. The dollar pretty much low changed after hitting a fresh record on Monday. Now, the U.S. Central Bank definitely kicks off its meeting today, but is expected to, again, hike rates by 75 basis points tomorrow. We heard from Miles Bradshaw of JP Morgan Asset Management saying if they go for 100 basis points, it's not exactly priced in the markets, and so that means treasuries could be all over the place. Now, the long hold strategies, of course, rooted in the idea that the central bank would avoid the disastrous stop-go policy of the 1970s that allowed inflation to get out of hand. So it's trying to front-run that inflation shock that we could get into the winter months. Coming up, Italy goes to the polls on Sunday. We'll discuss that next and look for market reaction. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Here's what's coming up on today's program. Go big or go home. Global central banks line up jumbo hikes. The Riksbank surprises with a 100 basis point rate increase. The Fed begins its two-day meeting. Inflation headache. Japanese CPI hits a three-decade high, piling pressure on the BOJ to justify continued stimulus. Plus, relaxing restrictions. Hong Kong weighs loosening hotel quarantine rules, easing travel for the financial hub. So another story that could be potentially market-moving. Italy goes to the polls this Sunday. A right-wing coalition led by Giorgia Meloni's Brothers of Italy will be hoping to make gains from the group of Enrico Letta's Democratic Party. We're joined now by Silvia Merler, head of policy research and ESG for Algebris. Silvia, thank you so much for joining us. I know you look at politics with a fine-tooth comb to also understand exactly what it means for the markets. The market, for the moment, is pretty sure that whoever comes in power next, and if you believe the polls, it's the center-right coalition, that will stick to the fiscal rules, that will be able to have the money from the EU. Are you so certain?
Good morning. Thank you for having me. This is clearly an election that's going to be closely watched by the markets and in Brussels, most definitely, because it might be a defining moment for Italy on one end and European integration on the other end. We know that much of what has been done in the past 2 years at the European level is now going to find validation in Italy's success in pulling forward its national recovery plan. I think from what we have heard from the center-right, the direction of travel seems to be pretty clear, and it seems to be to abide to the commitment that have been taken. There are, however, some elements of uncertainty, one of which is the coalition has stated that they might want to renegotiate part of that commitment in light of the changed geopolitical environment. And while this is possible, and to some extent, some of the priorities might have changed, there's uncertainty as to whether this is going to take, how much time this is going to take, how long, and what changes in the reforms might be envisioned that are committed to in the plan.
But Silvia, if we've seen actually in the manifesto, right, that they want to increase spending, first of all, can Italy afford it? And what does it mean for bond yields?
So this is a question that we will only be able to answer when we see what the balance of power within the center-right coalition, which is poised to win, will be. Because if you look at the different proposals that come from the three different parties that are part of this coalition, and you take all of them at face value, if the coalition were to implement all of them, we would be talking about a deficit in the order of 2% of GDP. Obviously, fiscal space for Italy is limited by the fact that the country has a high public debt load, and by the fact that it's one of the countries that has been spending the most over the past 6 to 8 months to counter the effect of higher energy prices. Italy has spent already almost 3% of GDP on this matter in the past 8 months. So I think it is very unlikely that all the pledges in the government, in the center-right government coalition agreement would be implemented. And so what actually gets done and the size of the impact on the fiscal balance will depend on the internal balance of power of the different parties that compose the coalition.
And I imagine, Silvia, that will also, and something they've been talking about is, rewriting or amending, for example, the Recovery and Resilience Plan that Italy had set up to access the EU funds. Does this also depend on the weighting of each party?
The coalition seems to be pretty in agreement on that point. So I think that will probably be the line of the coalition, regardless of the balance of power internally. Then when it comes to what potential redrafting may be looked for, then obviously, yes, that will also depend on whether we end up in a situation where the dominant party, which is likely to be Brothers of Italy, Giorgia Meloni's party, will have a significant gap, a significant advantage on the other members of the coalition. Now, on the rewriting on the plan, one thing I wanted to mention is some amendments might be even conceivable in light of the fact that the geopolitical situation has changed. And for example, if you look at money available under the Repower EU plan, which is the plan the EU has put forward to ensure national energy security in the context of the problems related to the war. The money that are on the table for that particular initiative are mostly coming from unspent or unrequested loans under Next Generation EU. Italy, being one of the countries that has already taken all its share of loans and grants under Next Generation EU, would therefore have very little money available extra for this particular spending type under REPowerEU. So in that sense, some rewriting of the already submitted plan makes sense, but obviously timing is the big question there.
Sylvia, talk to us a little bit about gas consumption. So it's unclear how friendly actually this new government will be with Russia's Putin. When you look at gas consumption, how difficult is it to reduce gas consumption, if I can get my words out, for Italians without putting them in too much pain, therefore losing the spirit that, you know, for the sanctions in Ukraine?
I think honestly there's been on the, let's say, geopolitical orientation of this government, at least so far, Giorgia Meloni has been very clear that it would be in line with the European agreement, and so preserving the direction and preserving sanctions on Russia. The separate question of how Italy has been approaching the winter, I think it's also very interesting, and winter is going to be a moment of tension for countries in Europe. In Italy, maybe one of the countries where this is felt the most. Italy is in a lucky position because of the opportunities that it has to diversify supply, something that's not available to Germany, for example, and it has done so. So it has already significantly increased imports from southern gas producers, particularly Algeria. On the other end, and this is maybe related, potentially with, you know, like having higher imports, reducing the urgency of acting on the domestic gas consumption side, Italy has reduced gas consumption only marginally compared to, for example, Germany. We have seen a 15% reduction in Germany over the past 6 months, and we have only seen a 2% reduction in Italy over the same period.
Sylvia.
So in a way, this I mean, this is a topic that must become central, I think, in the domestic political debate. The fact that we have elections so far into the autumn is likely to put pressure on the government when it is formed to deal with this.
Sylvia, thank you so much for joining us today. Sylvia Merler, their head of policy research and ESG for Algebris, joining us from Milan. Now, Ukraine again calling on Western governments for more weapons as it presses ahead with its counter-offensive against Russian forces. The foreign minister, Dmytro Kuleba, says Ukraine wants to add to its recent territorial gains and deny Russia any strategic advantage.
When you're fighting a war against such an enemy, you need more weapons. Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
And from the United States is already asking Congress for another $12 billion or so. The European allies have sent weapons. For how long are you going to be needing to ask for the increase of these supplies, the weapons and the ammunition?
Our recent successes in the east of Ukraine, I mean our counteroffensive, is an evidence that a combination of Ukrainian stamina and Western weapons, and most of them come from the United States, is the recipe to defeat Russia on the ground. So it's a clear message to everyone that it works, that it makes sense to help Ukraine with weapons, because we can defeat President Putin and his army in our territory. So, of course, the sustainability of supplies is an issue, and that's exactly what we are working on with our partners, not only in Washington, but also all across the globe.
You had this unexpected counteroffensive in the vast territories around Kharkiv. What's next?
Well, it was unexpected for some, but it was a thoroughly planned and well-thought military operation. The next phase will be to continue liberating our territories. We will continue our counteroffensive in the east of the country. I would like to recall that since 24th of February, the only region that Russia controls in full is this Lugansk region of Ukraine. Now, we have a clear goal of depriving Russia of this control, which will send a clear message that since 24th of February, Russia literally achieved no strategic gains in Ukraine.
I want to bring up the fact that what we're seeing in Europe right now, heading into very tough winter. In Germany, in August, power prices, electricity forward power prices peaked in August, 1,050 euros per megawatt an hour. That is normally 40, 45 euros. Are you confident Europe is going to remain this resolve?
Well, the prices that you have just mentioned is the direct result of President Putin's energy blackmail of Europe and the entire world. And while he blackmails the West with high prices, he literally blackmails Ukrainians with blackouts. A week ago, Russian missiles hit a number of critical infrastructure elements of our electricity grid, causing blackouts in two big regions of Ukraine, including the Kharkiv region that was liberated by our army. Last night, a Russian missile hit near Ukrainian nuclear power plant. And that nuclear power plant also contributes to our electricity grid. So we're facing kind of different levels of problems with our European partners, but we work closely with them in order to sustain this pressure coming from Russia. And I see that European leadership is committed not to allow Putin to succeed, and we are working with them.
Ukraine's Foreign Minister Dmytro Kuleba there speaking to our very own Anne-Marie Herder. Now, coming up, opening to the world, Hong Kong is looking to relax COVID curbs and reconnect after 3 years of quarantines. We'll have that full story next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in New York. Now, for nearly 3 years, travelers to Hong Kong have had to quarantine upon arrival, making plans to visit the island complicated. That looks like it's about to change. Now, for more on all of this, we're joined by Michelle Cortez in Hong Kong. Michelle, great to speak to you. So Hong Kong seems maybe a little bit closer, or closer than ever, to opening back up. What's the latest?
We are getting great news from Hong Kong today. It has been quite a long time in coming. At this point, what we're hearing is that the government is looking to cut quarantine out entirely when it comes to hotels. Until this point, travelers have had to go to a hotel either for as long as 3 weeks earlier in the pandemic, down to just as little as 3 days. That happened last month. And now we're hearing it's going to get to actually 0, which is great, because why would you want to go to a place and have to stay in a hotel for 3 days when you can't even leave your room? So hopefully that will open up. People will still need to track their own health for 7 days, perhaps not being able to go to restaurants or bars, some entertainment venues. The details are still a little bit unclear, but the idea that we're going to be able to get away from hotel quarantine is very exciting.
So, Michelle, I'm sure it is exciting after 3 or 2 very long years. How does the mainland feel about Li's plan to ease curbs?
We are hearing that Beijing at this point is looking favorably upon this approach. Certainly Hong Kong has suffered for the last 2.5, 3 years, and we see Singapore taking many of the activities, including many of the financial workers, people who are key to Hong Kong's success. So we do see a shift happening in China. We're not entirely sure what's happening there. China is still keeping COVID out entirely. COVID-0 is going hard in China, but not in Hong Kong. We're looking forward to changes, and we're not entirely sure when it's going to happen. We're looking for definitely by the end of October, hoping by the end of September.
Michelle, thanks so much. Michelle Cortez in Hong Kong for us. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ford shares have tumbled in late trading after warning supply costs are running $1 billion above expectations in the current quarter. The U.S. car maker reaffirmed full-year earnings guidance, but signaled shortages of key parts will keep its inventory of half-completed vehicles elevated. American Express says it's planning to add 1,500 employees to its technology arm. The card company has told Bloomberg that roughly 60% of the hires will be over in the U.S., with about a third in India and the rest in Europe. Amex has already added over 3,600 tech workers this year as a surge in post-pandemic revenue allows for new investments. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, 6 years ago, a little-known textile maker called Shandong Rui Group embarked on a frantic acquisition spree with the ambition of becoming China's version of luxury powerhouse LVMH. Since then, its ambitions have quickly started to unravel. Well, the story of that unraveling is the subject of today's Bloomberg Big Take. Here to tell us more is our distressed debt reporter, Irene Garcia Perez. Irene, first of all, really congratulations on a wonderful story. It's a story that I follow luxury, and actually I didn't know much about this. So first, how did it all come crashing down for this company?
So the company blames it on the COVID crisis, on the Sino-US tensions, and tighter credit conditions. And while none of that helped, that's for sure, it also happened that a lot of these acquisitions were funded with debt. So as it failed to re-energize some of the brands it had bought, it became harder to fulfill those obligations both domestically and abroad.
So what's next for the group?
Well, the group is still negotiating with creditors, and because of course it's better to sell it at a higher valuation later on than just selling it at a discount now, or even worse, just losing it to creditors.
So, Irene, talk to us about, through your reporting, what was the most surprising thing about this company? Is it actually the brand recognition that maybe also it lacked, which helped or was partly due because of its huge descent very quickly?
So what was, from my end as a credit reporter, what was most interesting is some of the people involved mentioning how when they tried to engage with the company, it was very difficult to just get a reply from them. They were very keen while things were going well, but all of a sudden they just disappeared when things started to go wrong.
Irene, thanks so much. Irene Garcia Perez joining us today. And if you want to read the full piece, and I suggest everyone does because it's a little bit different, it's something that not many people knew about, just type NI Big Take and go on your terminal or log on to Bloomberg.com. Now, coming up, back to business in the UK, Queen Elizabeth's 10-day mourning period has come to an end. We look at what's on the government's agenda. This is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in New York. Of course, what we're doing in New York is following UN General Assembly. This is as all the heads of state from all over the world arrive. We'll follow a couple of them very closely, the ones that have elections soon. I'm thinking of Italy. I'm thinking, of course, of Brazil. And then there's Liz Truss. This is her first foreign trip as prime minister. She only started her job about 10 days ago. But then, of course, that was superseded by mourning for Queen Elizabeth II. Now let's focus on the UK then. The country will begin to get back to business today after the funeral of the Queen and the 10-day mourning period. Markets open again after yesterday's break. Parliament will be back in session. Well, the Prime Minister, Liz Truss, has touched down here in New York for her debut as British Prime Minister. Bloomberg's Lizzie Burden now joins us with the very latest. And Lizzie, I know we have a reporter, of course, who was on the plane with Liz Truss, Kitty Donaldson, and she had quite a lot of breaking news in terms of trade and actually what Liz Truss wants to accomplish in her trip here in New York.
Indeed, and it looks like a US trade deal is not going to be negotiated in the near future. Liz Truss doing a little bit of expectation management there. That was something that was meant to be one of the biggest prizes in the crown of post-Brexit opportunity. But despite Truss being the former trade minister and the former foreign secretary, she is not seeing this as something that's likely. It didn't look likely under Donald Trump, let alone under Joe Biden, especially given her relationship with him over Brexit, but it'd be interesting to see how their conversation goes this week. Also this week, though, on the domestic agenda, we're expecting a mini budget from the new Chancellor Kwasi Kwarteng, and he's expected to walk the walk on all of these tax cut pledges that Truss made during the leadership campaign, as well as to announce a 2.5% growth target. So really, this is the chance for Trussonomics to come into fruition.
Yeah, so if you look, and this is, as you say, a huge week for Liz Truss because of that mini budget by her chancellor on Friday. But of course, she's also meeting with Emmanuel Macron. Maybe Biden will ask her some questions on the Northern Ireland Protocol. How big a week is it for Liz Truss?
Massive, premiership defining, really. She needs to set the tone policy-wise. She already managed to squeeze in, before the sad news of the Queen's passing, an energy bailout for consumers. Now she has the chance to follow it up with an energy bailout for business. And as well, we're expecting an announcement on how the government is going to deal with National Health Service backlogs, which of course perhaps are contributing to the inactivity rate, which is keeping the labour market tight. So all of this is Truss's opportunity to deal with the massive economic crisis facing the UK. The question is, though, how much will it add to borrowing and inflation itself, given how weak the pound is? We saw it hitting the lowest since 1985 last week on the anniversary, the 30th anniversary of Black Wednesday.
Yeah, a big deal, of course, when you look at sterling weakness. So what can we expect from the BOE this week?
Well, at the moment, it's between 50 and 75 basis points, it looks like. Earlier, we learned that markets are now seeing 3 75 basis point hikes by year end. There's a 60% chance, according to them, of a 75 basis point hike on Thursday, although that's down from 80%. Really, it's a question of the short-term inflation picture, given the help that the Truss energy bailout for consumers will give. Our economists at Bloomberg Economics reckon it will soften the blow to the extent that all we're going to see this week is a half-point hike. And I say all, that's compared to the Fed and the ECB. 50 basis points now looking somewhat dovish in the international context.
Yeah, there you go. Who would have thought? Hey, Lizzie, thank you so much. As Lizzie was saying, money markets pricing in 200 basis points actually of hikes over the next 3 decisions for the Bank of England. Our Lizzie Burden. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, Anna Edwards in London. We look at markets for the moment. Stocks pushing higher in Europe. We'll see how futures open in the U.S. The stock 600 pushing higher as investors shifting positions ahead of a flurry of central bank decisions this week. That is, of course, led by the Federal Reserve. The U.S. Central Bank kicks off its meeting today, but then is expected for the moment to again hike rates by 75 basis points on Wednesday. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between 2 of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the 2 account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We're definitely seeing resilience in the U.S. economy.
Trying to sort of engineer the soft landing, I think, is a very delicate dance.
We still got to get to the next CPI print before you can have any sort of clarity at this point.
It's a great opportunity for the Fed to continue to raise interest rates.
I think quantitative tightening is going to keep a lid on the ability for bonds to really, really rally.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Central banks take center stage. Sweden raises rates by a full percentage point. The Fed begins its two-day meeting, and traders are betting the Bank of England will boost rates on Thursday by the most in more than 3 decades. Tale of two automakers. Ford declines after warning of the impact of inflation. Meanwhile, Porsche's record IPO is covered multiple times within hours. And Hong Kong wants to end COVID rules like mandatory hotel quarantines that have made travel difficult, of course, since 2020. China signals its approval. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, markets here in Europe a little sluggish. It seems to be in a sort of holding pattern, waiting for further central bank news. We've heard from the Riksbank, but of course, the Fed, the real focus of this week.
Yeah, will they deliver a surprise like we got from the Swedish Central Bank this morning with a 100 basis point move, Anna? The move everyone is expecting is 75, but as we know, there is always room for surprises either way. Now, as for how markets shook out in the Asian session overnight, after we saw that late rebound in U.S. equities yesterday, you saw some follow-through buying in the region. The MSCI Asia Pacific Index actually higher for the first day in 6, rising about 0.7%, and really the outperformance coming from Hong Kong on that story that Anna mentioned, that they are looking to ease up the quarantine, mandatory quarantine in the hotels for travelers there, easing COVID policy that has been in place for quite some time. And that, in theory, should be a big boost to the Hong Kong economy. So the Hang Seng Index up about 1.2%, and certain reopening sensitive stocks in particular, like Cathay Pacific, the airline, higher by about 2.2%. It actually hit its highest since June of 2020 in this session. And finally, in foreign exchange, I would just point out that for the 19th day in a row, we got a stronger than expected fixing bias from the PBOC for the Chinese yuan, really trying to shore up support for the currency, and yet it does not seem to be working because once again, the yuan weaker against the US dollar today, trading north of that 7 handle at 701.94, Matt.
All right, we'll continue to watch the currency story, of course, but I'm really focused in on rates. Here you can see, first off, futures down just about 0.1% after we had that turnaround in trade yesterday. We ended the day in the cash trade up about 0.7% across the board. But really, it's the rates picture that I think is important. You see these red arrows? No, they're pointed higher. They should be green. Right now, we see the U.S. 2-year yield continuing to climb 3.9686. I haven't talked to Bramo about it today, but I know she is on 4% watch for the 2-year. And then yesterday, we saw the 10-year get over 350 for the first time since 2011. Right now, we're at 352. So we see these rates climbing, but the smaller one is climbing faster than the other, the bigger one, and that's why the inversion continues to grow. Finally, you look at Bitcoin. It's come back a little bit. Remember, yesterday we were trading under that $19,000 range for most of the session. Now we're at 19,316, so getting closer back to that $20,000 range, but really still stuck in the same space. Anna, what are you looking for in terms of European trade?
Well, I've got more on the rate story, just in keeping with what you were saying in a moment, Matt. But here's the equities picture for now. And we're seeing selling across equities. The London market coming back after being closed yesterday, so catching up a little bit. But elsewhere, we're down 0.5%, 0.4% on the CAC and the DAX. So selling across Europe. Our colleagues on the Markets Live blog saying we are at our cheapest for European stocks relative to US stocks when you look at forward PEs, is being cheap enough, though, when you've got things like the gas crisis hanging over Europe. Speaking of that, let's check in with that gas price, because we have seen that gas price coming down in recent sessions. We're now down at 181, down by 0.2%. It was down a lot more than that earlier on in the European session, ever since last week when we heard from Ursula von der Leyen and what the plan was there to try and tackle the gas crisis. Add into that the money the Germans are putting aside to save, to spend on gas, and the deals they plan to do this weekend as they head to the Middle East. All of that in focus. Here's back to the rate story. We got a surprise this morning, as we said in our headline. headlines. 100 basis points of tightening, a whole percentage point from the Riksbank in Sweden. Does that have any read across into other central banks? A question worth asking. And in terms of the market reaction, it was interesting to see what we got there, because the Swedish currency did gain initially. There was guidance that more hikes will come as well, but then it unwound the gain. It seemed that the central bank, at the same time as hiking rates, also adjusted where they expect the terminal rate to be. That came down. The market had already priced that in, and so it unwound the initial gains in the currency that we'd seen. The UK two-year yield, in keeping with what Matt was saying about those two-year yields, those short-term yields going higher, we're seeing that here in the UK as well. And as we said in our headlines, the market's increasingly pricing in a hawkish Bank of England this week and in November and maybe in December, where we get 75, 75, 50. The market's pricing in 200 basis points over those 3 meetings. Volkswagen in focus, up by 1.7% today. They have said that the Porsche IPO has got plenty of money behind it. Plenty of investors want to pile in, want to subscribe to this initial public offering. And it would be, Kaylee, the largest. It will be. When it goes ahead, it'll be the largest in Europe for more than a decade.
All right, we're going to have more on that story in just a moment, Anna. First, though, let's get a look at what is ahead today. The United Nations General Assembly is kicking off here in New York, with leaders around the world descending on the city. So gear up for traffic this morning if you have to commute to work. Then the UK also getting back to business after the funeral of Queen Elizabeth II, with markets open and Parliament in session. Dock workers at the Port of Liverpool are set to begin a 2-week strike at the nation's 4th biggest gateway for global trade. Nobel laureate economist Joseph Stiglitz is among speakers at the Nordic Business Forum. And finally, on the economic data front, we'll get some here in the U.S., including building permits and housing starts, Matt.
All right, we'll definitely be on UN watch, at least for today. Let's take a look now back at Treasury yields. The 2-year yield's poised to crack 4% for the first time since 2007. The Fed's steepest tightening cycle in a generation, driving them higher. Bloomberg's Christine Aquino joins us now to tell us what this really means, Christine. And we see also the yield curve inverting even further.
Absolutely, Matt. And I think, if we are going by where the terminal rate is for the Fed and whether the 2-year follows that, then it's going to have to go much higher from here, because at the moment, markets are pricing for that terminal rate to be at 4.5%. And we're still on 4% watch, as you mentioned, on the U.S. 2-year yield. And so it has a bit of a ways to go before it gets there. Of course, the question is what's going to take it there. And a lot of other things factoring into this as well, primarily where Fed officials themselves expect the terminal rate to be. The last update of the dot plot that we saw over the summer hasn't even factored in 4.5% yet. So let's see if that kind of all converges toward that terminal rate level. And as far as the inversion goes, again, this really just puts us back into even deeper inversion territory. Of course, we all know that that is less of a signal about upcoming recessions as it had been in the past. What I'm personally worried about is what happens when that curve starts steepening, and when those longer term rates, the rates that really matter for the real economy, also start going the way of that shorter end move higher here.
Okay, so a lot of focus on the short end in the US, also in the UK, as we mentioned earlier. Christine, we'll get more on that in a moment. But let's think about what we heard from Sweden, because it's important for Sweden, but also because of maybe a precedent it sets, or at least the questions it raises about how aggressive, how hawkish central banks globally are this week.
Absolutely, Anna. I mean, if we go by what we saw from the Riksbank, from the Bank of Canada, a lot of these smaller central banks really are in quite a tough spot and feeling the pressure to deliver even more than what we've seen from the bigger central banks. And I think this is going to be the story. 100 basis point rate hikes, you wouldn't think of seeing that from a developed market central bank even just a couple of months ago, but this is the situation that they're in now. If they're a smaller open economy levered to these bigger economies, then they're going to have to do even more to outdo the Fed, the ECB, and all these other bigger central banks.
All right, Bloomberg's Christine Aquino, thank you so much. And speaking of other central banks, traders are rapidly dialing up rate hike wagers for the UK, betting the Bank of England will deliver 2 outsized increases by the end of the year. Bloomberg's Lizzie Burden is joining us now. So Lizzie, 2 days to go. What can we expect from the BOE on Thursday?
Well, Kaylee, it's between 50 and 75 basis points. As you say, markets are dialing up their bets. They now see 200 basis points of hikes in the next 3 meetings. In other words, 2 75 basis point hikes by year end. They see a 60% chance of 75 this week, But our economists say that the Truss energy bailout, which is going to cushion the blow of energy price hikes for consumers, actually means that the inflationary impact will be lessened, and so we'll only see a half-point hike. And most economists surveyed by Bloomberg actually agree with that. The other question, aside from the rate decision, is what the Bank of England does with active sales of gilts. They were meant to begin now, but given all of the borrowing that the Truss energy bailout and the tax cuts that we're expecting in the mini budget on Friday are going to entail, does that mean that the Bank of England needs to put the brakes on active quantitative tightening for now?
All right, Bloomberg's Lizzie Burden, great reporting as always. Thank you so much. Let's turn now to Asia. Hong Kong wants to relax COVID rules like mandatory hotel quarantines that have made travel difficult since 2020. That's according to the city's chief executive, John Lee. He spoke earlier.
While we will do our best to control the epidemic, we aim to have the maximum connection with the international world and also to reduce the inconvenience to people who arrive at Hong Kong. That is a very clear goal, and that goal, I am maintaining it in one direction.
For more on this, we're joined by Bloomberg's Michelle Cortez in Hong Kong. So Michelle, just walk us through what the policy in theory would switch to and ultimately how much of a game changer this is for post-COVID Hong Kong.
What we're hearing at this point is that they're looking to entirely end the hotel quarantine. So that means this plan, which used to send people to a hotel for up to 3 weeks when they couldn't leave their room, now will have no time in a hotel. Instead, they can stay in their homes, just taking their temperature, perhaps testing to make sure they're not incubating the virus. There might be some restrictions on where they can go outside of their homes, whether there's limitations on restaurants and bars. But after 7 days, it's going to be free at last. And I tell you, there's a lot of excitement here in Hong Kong about this idea. It's really going to open up travel and make it possible for the city to reconnect with the rest of the world.
Yeah, I can tell you that it's pretty awesome to be in a country where the pandemic is over, at least according to President Biden. Michelle, thanks so much for joining Michelle Cortez there from Hong Kong. Let's get to the car maker news now. Volkswagen is paving the way for Europe's largest IPO in a decade. The automaker has published the securities prospectus for an IPO of its Porsche sports car unit. The books for the share sale are open now and have already been covered multiple times. Christoph Rauwald, our Frankfurt bureau chief, joins us for more. And Christoph, it looked like already they came out with a pretty easy valuation to hit 70 to 75 billion. There had been talk of, an 85 or 90 billion dollar valuation, and now this has been oversubscribed. Tell us about the demand.
Yeah, the demand seems to be very strong. I mean, the order books basically just like opened a couple of hours ago this morning here in Frankfurt, and basically, yeah, as you mentioned, the order book has already been oversubscribed basically, and yeah, I think we still have like a week to go. The first day of trading is planned for September 29th. So yeah, really off to a pretty strong start. And I think it does pay off probably that they didn't price it too aggressively as we discussed yesterday.
Off to a strong start then, Christoph. I mean, the significance of this is difficult to overstate, really, isn't it? The size of this IPO when we finally see it, Christoph, it could be Europe's largest IPO in more than a decade.
And in an awful market.
Yes, I think. Yeah, in a totally awful market. I mean, Matt, we talked about it over the past few days and weeks, really. I mean, the market conditions could hardly be more difficult, probably. But it also goes to show that Porsche, as a company, has shown over the past few years that it can navigate any crisis scenario relatively well when compared to, like, direct peers.
All right, Bloomberg's Christoph Rauwald, thank you so much. And we'll have more on the Porsche IPO later this hour with Jefferies Global Autos analyst Philippe Houchois. And we'll also be discussing Ford because the automaker is the latest major company to warn about economic pressures weighing on operations. Ford is warning that inflation is pushing supply costs $1 billion higher than expected in the current quarter. It now expects adjusted EBIT in a range of $1.4 to $1.7 billion when it reports results next month, well below what it reported last year and a year ago. Ford also says shortages of key parts will keep its inventory of half-completed vehicles elevated. As for how that is impacting shares in pre-market trading this morning, they are down and down rather hard, down about 5% before the bell. And again, we'll have more on this story in just a moment. It's a bit more positive story, though, when it comes to some of those stocks sensitive to the China reopening story, the one we were just discussing specifically with Hong Kong with Michelle Cortez, including U.S. casino operators that have big operations in Macau, the likes of Las Vegas Sands, higher by about 3%. And another big mover in early hours is Change Healthcare. This is after United Health won court approval for its $7.8 billion takeover of the company. The DOJ had been suing to block the deal, but no luck for them. And as a result, Change Healthcare up about 7% before the bell, Anna.
Yeah, Kaylee, interesting to see that news out of Ford not weighing on European stocks today, not weighing on European auto parts companies. That's the best performing sector here in Europe. More, as you say, on the auto sector later. Coming up shortly, though, Sam Linton-Brown joins us, BNP Paribas Global Head of Developed Market Strategy. Where does he see rates heading from here? A lot of focus on the short end as we head towards some really important central bank meetings this week. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. All eyes on the Fed, really a slew of central banks out, but the Fed, of course, the leader in this charge. And we are now pricing in a terminal rate of 4.5%. That's more than 100 basis points higher than the terminal rate we were pricing in before the last Fed meeting. So things move pretty quickly in the world of finance, and it's getting more and more difficult to raise debt. Joining us now is Priscilla Azevedo-Rocha, Bloomberg credit reporter, to talk about the effects, Priscilla, on companies. I mean, they're all coming to market, but the window is closing quickly, isn't it?
That is true, Matt. Thank you very much for having me. So today we're seeing like this urgency to come to the markets. We have a lot of companies selling debt here in Europe, but we're seeing that this urgency is actually ahead of central banks, is that the window will eventually shut, right? The only way now we know that rates are going up and those companies that need money, they need to tap the market.
So is this a global phenomenon then, Priscilla? I mean, clearly the Fed is in focus, as Matt said. We've got rates going up in other parts of the world, though. I mean, how is this impacting on bond sales here in Europe?
No, it's absolutely, Anna. This is a global phenomenon, but I think here in Europe in particular, the narrative is that this rush is here to stay, right? So we're seeing today in the market, we have everything. We have from sovereigns, we have banks, companies are rushing to the market to sell debt, and we saw that in the US last week as well. And this is like anticipating this hike path. All we know now is that rates are going up, right? So.
Well, and in the UK as well, ahead of the BOE decision on Thursday, what's happening with sterling credit?
Well, the narrative is pretty much the same, right? This morning we saw a sell-off in government bonds ahead of the BOE meeting. There's this sense among investors of caution. We have a cost of living crisis here. We have like expectations of what's going on Thursday. Also, there's a lot like investors are shifting position ahead of what's going on Friday, right? When the government will announce the energy crisis, the measures, and how much is it going to cost, and we're going to have more clarity over the shape of the measures to come.
Yeah, sort of mini budget expected in the UK on Friday. A fiscal event, they call it. Priscilla, thank you very much. Priscilla Azevedo Rocha joining us now to talk about credit markets. And for more market analysis across all asset classes, MLIV Go is the function to use for the Markets Live blog. This is Bloomberg.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. No No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Britain's new Prime Minister Liz Truss says a trade deal between the UK and the US is unlikely in the short to medium term. She says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting of the UN General Assembly. President Biden's vow to defend Taiwan with U.S. forces if China invades is making a U.S. policy shift explicit. A spokeswoman says the president's comments on CBS's 60 Minutes did not mean that policy toward Taiwan had changed, but the remarks are being seen as a reversal of decades of so-called strategic ambiguity in which the U.S. refused to make its intentions clear. Hurricane Fiona has exposed Puerto Rico's fragile power grid. The storm caused a general blackout that affected the entire U.S. territory of 3.1 million people. The power outages hit just as Puerto Rico's Electric Power Authority is dealing with a bankruptcy that has no clear end in sight. And in Japan, inflation has accelerated to the fastest pace in more than 3 decades. That creates headaches for the Bank of Japan. It will try to explain why it needs to continue with monetary stimulus when inflation is above its 2% goal. Consumer prices, excluding fresh food, rose 2.8% in August from a year ago. And Matt, it's a question we've been asking a lot as you have global central banks, ex the BOJ, tightening policy in dramatic fashion. Kuroda is keeping things easy, keeping with yield curve control, and you've seen that borne out in the weakness for the Japanese yen.
Yeah, now they're looking at least a little bit of inflation, and that could help market forces that are already pressuring some increases there. So it'll be interesting to watch Japan. Anna, it seems like we've been watching every other central bank but.
Yeah, core inflation in Japan at 2.8% doesn't seem high by global standards, does it? But I can understand how it is significant in the Japanese context. More on bond markets in a moment. The US 10-year real yield rising to the highest since 2011 as we continue to focus on that higher yield environment. We'll get the thoughts of Sam Linton-Brown, BNP Paribas Global Head of Developed Market Strategy. That conversation coming up shortly. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Central banks take center stage. Sweden raises rates by a full percentage point. The Fed begins its two-day meeting, and traders are betting that the Bank of England will boost rates on Thursday by the most in more than 3 decades. Tale of two automakers. Ford declines after warning of the impact of inflation. Meanwhile, Porsche's record IPO is covered multiple times within hours. And Hong Kong wants to end COVID rules like mandatory hotel quarantines that have made travel difficult since 2020. China signals its approval. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Matt was really taken by our colleague Michelle in Hong Kong earlier on, and I spoke to her a few times this morning. She did seem really pleased by that news, the freedom it gives you in Hong Kong if you're able to travel more freely. Talking about freedoms, let's think about where we are on the market conversation, because we're kind of in limbo. We seem stuck, little tied, given what we're waiting for the Fed, waiting for that big central bank news.
Yeah, absolutely. I mean, that typically happens, and we did actually see a big move in the cash trade yesterday. The U.S. market jumped about 0.7% in the last hour of trading. We do have futures now that are back down about 1/3%, and you could see drops just depending on the hawkishness that we get. Is it even stronger than had been anticipated, as evidenced by the Riksbank coming out with a full 100 basis points? Taking a look at the 10-year yield, Kaylee pointed this out to me. We've seen a jump in the 10-year yield to 117, almost 118 now, and this is something that Tom Keene and the the OG surveillance team is certainly going to be focused in on. What does that mean for financial conditions? Because they're still pretty loose, frankly. NYMEX crude is coming up just 10 cents a barrel to 85.82, but I only put it in there to indicate that it's not all about the dollar, right? We have some real assets moving higher like oil and some moving lower. Gold down to 1668, the lowest level that we've seen really since March or April of 2020 as the Fed continues to hike rates. Kaylee, what do you see in terms of pre-market movers?
Well, there is a lot related to that move higher in the 10-year real yield adjusted for inflation, because we know that weighs heavily on stocks with higher multiples. So you're seeing a lot of those big tech stocks down hard in pre-market trading. But I actually wanted to focus on another group of stocks, and that would be the autos. After Ford yesterday after the bell warned on higher than expected supply costs, about $1 billion more than expected. So their adjusted EBIT's going to be lower than anticipated, both on a year-on-year basis and relative to the quarter they reported last go around. So that is dragging Ford down about 5% and taking peers down with it. GM is down by about 2.25%. It's a more positive story, though, for some of those stocks related to the Hong Kong reopening story that you and Anna were just discussing, the idea that you won't have to quarantine in a hotel when traveling to Hong Kong, and maybe that makes it a little bit easier to go to Macau and gamble. So as a result, some of those U.S. casino operators that have big business in Macau, Las Vegas Sands, and Wynn Resorts each higher 3% before the bell, Anna.
Kaylee, really interesting. You mentioned what we're seeing in Ford and the wider auto sector. Interesting to me that that's not really spilling over into the European session. Auto stocks actually doing pretty well today. More on that in a second. This is the broad picture across the stocks Europe 600, then down by 0.4% today, giving up on those early gains we saw in European markets as we tried to play catch up with those late in the day gains on Wall Street that Matt referenced. Here's the Volkswagen share price, up by 1.8%. This is in keeping with other stocks in the sector, though. It's not just VW going higher, although there is specific VW news around the attended IPO of Porsche. We'll get more analysis on this shortly, but we could see, of course, the biggest IPO in Europe in more than a decade, and it seems it's well covered. There's plenty of demand for this IPO. That's what those who are raising this money are telling us this morning. Here we've got the Swedish krona against the euro. So here you've got the euro on the move here, and the Swedish krona actually giving up earlier gains. Those gains were triggered by a bigger than expected hike in interest rates from the Riksbank, 100 basis points, a whole 1% from the Riksbank. That was higher than the 75 basis points that had been expected. Does it set a trend? It didn't support the currency for very long, though, because of interesting things that the central bank said about rates, where they would peak out later in the cycle. And the UK 2-year yield, again, in keeping with that rally in short-end rates that we've seen, and a lot of the repricing of rate expectations globally. Well, the Bank of England is part of that story, part of that narrative. Will we get 75, 75 and 50 from the BOE? That increasingly seems to be the market's thinking, Kaylee.
All right, Anna, well, let's continue getting thoughts from other markets guests as well. Joining us is Sam Linton-Brown, BNP Paribas Global Head of Developed Market Strategy. Sam, as Anna alluded to, it's a big central bank week. We already had an upside surprise from the Riksbank this morning, a move of 100 basis points. What kind of surprises do you think we could see from the Fed tomorrow and the BOE on Thursday?
Good morning. Thanks for having me on. The market this week is really focused on the overall framework over what's the path through inflation, how does the labour market fit into that, in turn then how will central banks respond, and therefore what's going to be the effect on the market. I think the Riksbank template will prove quite relevant for the Bank of England, where there's upside risks to what the market prices in. But in terms of market reaction to that, I think the currency will weaken if the central bank hikes by more. And this is because from the perspective of the foreign exchange market, front-loading rate hikes into a recession is not positive. It's tightening for the wrong reasons, and in turn, the currency impacts are likely to be positive. We saw this over the past few years in emerging markets. More rate hikes have typically corresponded with a weaker rather than a stronger currency, and I think that will provide an accurate template for the Bank of England. For the Fed, 100 basis points is a risk, but it's not our central case. We think it's unlikely. We think the Fed will deliver 75 basis points. More important for the market, though, I believe, is really going to be the data in the US. As I said, what's the path for inflation? Because we know that central banks are very data dependent. They're taking a meeting by meeting approach. The data is volatile. And in that respect, the forward guidance from central banks is less impactful than is typically the case. And what really matters here is US data.
That's really interesting, Sam, on the BOE, the idea that rate hikes could weaken the currency rather than making it stronger. I'll let Anna touch on that. I wanted to grab hold of the Fed and look at with you a chart that Valerie Teitel put together. She's one of our crack producers out of London. And check this out. The Fed continues to raise rates, but financial conditions just get looser and looser. Does this tell you that they're going to have to go further faster?
I don't think they'll go faster. That would imply a pace of more than 75 bips ahead of us, which is not what we expect. And I'd say the key point here is, from the Fed's perspective, they distinguish between the amount of tightening that's needed when rates are at zero versus the amount of tightening that's needed when rates have already reached what they might consider neutral or possibly even restrictive after the meeting this week. So the Fed are going to balance that message that the amount of tightening from here needs to be considered in the context of what's already been delivered and the lagged impact that will have on the economy. But also the Fed will need to be hawkish. Inflation surprised to the upside again. There's uncertainty over the degree to which core inflation is going to fall, even if headline does decelerate as the market prices in. And so the Fed will really need to deliver a hawkish message in line with recent Fed speakers.
As Matt was talking about earlier, Sam, fairly loose financial conditions when you look back over where they were at the start of the Fed hiking cycle, which might not be what the Fed wants to see. I talked to a colleague earlier about why that was, and he was flagging to me the fact that the VIX hasn't taken off, and various other parts of the bond market have not seen spreads widening in the way that you might have anticipated with higher rates. Do we need to see some more sort of quote-unquote chaos before we get capitulation for markets and then can start to say, yes, we really have arrived and we really can look ahead to some sort of pivot?
It's interesting you bring up VIX, equity volatility in the US, and I think it's an important point because we'd actually argue that the fact that US equity volatility hasn't repriced higher makes some sense insofar as if the economy surprises on the upside, while that's good for equities, the Fed will tighten by more. That therefore cuts the right-hand side tail of the positive distribution for equity returns. But equally on the downside, because the labor market is so strong in the US, because underlying economic momentum is decent, there's not a lot of downside there. So I'd argue that the failure of US equity vol to reprice higher is quite consistent with the macro backdrop we have. And the similar sort of calmness, relatively speaking, that we've had in US risk assets, we think is justified by the underlying macro backdrop and the Fed's reaction function to it. But as you say, for them, it doesn't help them because they're targeting tighter financial conditions. And with the strength in risky assets we've seen, that implies they might need to do more. And this is a key distinction with Europe. Whereas if there is a US recession, it's going to be highly likely policy induced as a result of the economy proving, if you like, too resilient, such that growth doesn't soften enough, so that the labor market doesn't weaken enough, so that core inflation doesn't come down enough. And that's quite a different situation to what we find in Europe, in Sweden, as we saw today with the Riksbank, what we're going to see later this week with the Bank of England, and also what we saw recently with the ECB, where the nature of the economic challenge is less policy induced and more the external shock. And that has very different market implications.
And just on those market implications, specifically here in the US, do you think the bottom is in already?
For equities, I think we're going to be in surprisingly narrow ranges, given how much uncertainty we're going to have in rates on the basis of, as I said, the underlying backdrop caps the downside, the Fed's reaction function to that underlying backdrop caps the upside. I think for US rates, already we price a lot of volatility. So the level of front-end interest rate volatility in the US is super high, and we think that's actually fairly priced. It reflects that the backdrop is very uncertain. But if anything, we think that's where you might see some normalization in volatility markets first. Where we do think you can still have a further repricing higher in uncertainty is in foreign exchange markets, where volatility, although it's risen a lot, we think it can stay supported. And there's a number of exchange rates where we think it can reprice higher still. One of those is dollar Swiss, another is dollar yen. And outside of the US, we'd also suggest that investors focus on European volatility, especially euro cross vols in FX, which in our view don't correctly price how much idiosyncrasy there is to the European backdrop.
Sam, thanks so much. Thanks for joining us. Sam Linton-Brown there from BNP Paribas. We'll get further analysis on the auto sector. We talked about this a couple of times already this morning, but really interesting to get some perspective from an analyst of the sector. It's one of Europe's largest listings in years. We will discuss the latest with the Porsche IPO next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards out of London. Let's look at Porsche right now, a monster IPO that has been multiple times oversubscribed within hours of the books being opened. At the same time, Ford says inflation is boosting costs by over $1 billion in just one quarter. Joining us now to talk about these two issues is Philippe Houchois, global autos analyst at Jefferies. I guess we should start with Ford because that's going to have the most impact in the next few hours, Philippe, as the U.S. market opens up. Kaylee has shown us the stock is already down 5% in the pre-market. What does this say about the global inflation picture, the supply chain snafus? It's not over, is it?
No, exactly. I think there was Ford did a better job in the last 2 quarters of fixing some of the heavier disruption that they suffered compared to some of their peers, but it's catching up with them. And if it's catching up with them, it's probably catching up with others. Some of the competitors like Stellantis are a bit more careful about easing supply chains. They can improve and right a bit. And of course, inflation is biting in a bigger way than car makers were willing to admit a few weeks ago.
So I guess the Fed raising rates isn't really going to help all that much. What do they need to do?
Well, I mean, the whole industry has to. The industry and the economy has enjoyed 10 plus years of falling cost of money, and more recently in the auto industry, this tightness of supply was very helpful, and then used car prices were doing extremely well, which actually makes new car prices more affordable, and all that is reversing. And so you basically, there's a bit of a Goldilocks situation during the restriction of COVID, and all this is normalizing. The positive still is that there seems to still be a shortage of cars. So we're not looking at a big decline in car sales from here, but the cost of buying a car and the inflation of materials going to the car are going to have to be compensated somehow or translate into lower profitability, which, to be fair, the market has started to price for some time already.
Philippe, good morning. So the market has started to price that for a while, has been pricing that in for a while. Are there some manufacturers then, I imagine there are, that are managing these challenges better than others?
Porsche, maybe?
Yes, whoever has more pricing power. So, Ferrari, Porsche, those businesses have a bigger backlog of vehicles. Also, in some cases, my understanding, when you buy a Ferrari and the delivery is going to be 12 months later, well, the price is not completely set. The price needs to be adjusted as you get closer to the delivery. So those car makers have ways of adjusting that maybe more volume car makers do not. And then if inventories do come back at dealer levels, then dealers will set more of the price than what we've been able to experience during COVID. And that is also going to be another variable in the pricing environment for the car makers.
Well, Philippe, clearly Matt really wants to talk about Porsche, so let's talk about it. What do you think of the 75 million euro valuation and how ultimately the public market is going to receive this IPO?
Yeah, well, I think the noise around this IPO has been relatively transparent. The press was quite active in giving us ranges of 60 to 85. No surprise, this range now is narrower and comes back towards the middle of that range. We've been on the road a lot talking to investors about this IPO, and clearly there's a lot of interest in it. So I would say, we have to keep in mind this IPO is unusual in the sense that it is aimed to reach a balance between a decent price for the seller, Volkswagen, and a manageable price for one of the buyers, Porsche SE. So it's not a traditional book build where you might expect upward pressure on the price, because this is a fully formed business with a very strong track record. So this business, this IPO is coming at a level which seems maybe a bit lower than what the underlying interest or demand that I'm hearing from investors when I speak to them. And I've been speaking to them for the past several weeks.
Well, some investors are, you know, giant institutions that are already set and buying big chunks. Others are probably retail investors who just want to put their certificate up on the wall. What do you think of the valuation of Porsche in terms of, you know, price to sales compared to your typical automakers, your big volume manufacturers, and then also compared to like Ferrari and Tesla?
Yeah, of course. No, I mean, it is a different animal than car makers, but it is not Ferrari at all either. And if we look at the valuation that is implied in this range against our numbers, looking at 15 times earnings, maybe 13 times EBIT, those are pretty much half the multiples of Ferrari. But the returns on capital of Porsche also half those of Ferrari. So there's logic in there. And then discussions with investors, of course, was you could argue Ferrari is a beautiful business in terms of returns. It also has a solid governance and very good liquidity. And the last 2 points are still question mark around the IPO Porsche. So that's going to be, but of course, for Porsche management, Ferrari is going to be the benchmark, and they will have to see how they get close to that benchmark. Against the rest of the industry, and of course, post-COVID, car makers are pitching to investors that they are going to be better car companies going forward, less volatile in earnings, higher returns. But of course, the market wants to validate that first. And Porsche has shown for years that they were delivering very strong margins, good cash conversion. So that volatility that impairs the valuation of car makers doesn't really burden the valuation of Porsche.
Philippe, you've told us the very sensible story. There's more to these companies than just a ticker name. But I know Ferrari is race. Do we know what Porsche might be?
I'm not quite sure. I think I heard something, but they've tried something funny in the same way that they've chosen to have 911 million shares. So there is definitely a sense of humor in Stuttgart.
Excellent. That's what we look for. Thank you very much, Philippe. Thanks for the analysis. Philippe Pouchois, Global Auto Analyst at Jefferies. Thanks for your insights. Now, world leaders are descending on New York, as Kayleigh was saying, for the United Nations General Assembly. We'll get further updates on what to watch for there shortly. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
For a young person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
That was Ukraine's Foreign Minister Dmytro Kuleba speaking with Bloomberg's Anne-Marie Hordern at the United Nations, which brings me to what I'm watching today, Matt and Anna. The United Nations General Assembly begins today. It runs through September 26th. Obviously, the war in Ukraine is going to be very high on the agenda, but more importantly for New Yorkers like me and Matt, it's going to mean more traffic in the city. So give yourself a little extra time to commute this morning if you haven't already factored that into your plans, and just keep in mind that it's going to take you a little while longer to get around the city, especially on the east side with that going on down by the water, Matt.
Yeah, I would like everyone else to take public transportation.
But not you?
That would be I can't. I like to have my own stereo system and everything.
Of course.
I'm watching the 4-day work week. This is something that I think most people consider a joke. I can't wait to share it with my radio co-host, Paul Sweeney, a little bit later. He's already angry that people phone it in so much these days. But actually, there is a pilot program being tested out across across 180 companies over 6 months. The UK results have come in. Now, 78% that participated in this pilot program said the transition to a 4-day work week was good or seamless. 86% are going to keep to this schedule. So they'll continue having just a 4-day work week, just 32 hours a week, basically, for employees, but pay stays the same. And the key part is productivity stays the same. For almost all of these companies, 95% said productivity stayed or actually improved. You had 49% that say they boosted productivity with this because workers were happier and willing to do or able to do a better job. And I just think it's really a fascinating idea. Why not have a 3-day weekend?
Matt, sounds like you need to move back to Europe with this in mind. I remember I spoke to the organizer of this. She's from New Zealand, and they tried it on their business, and it seems to be doing well. Anyway, excellent, really interesting story. No such thing as a 4-day week if you work for the UK government, though, right now. You need to get back to work, back to business. We've got energy news to come later on this week. We've got a fiscal event taking place on Friday. The Chancellor there, what will he be giving us in terms of taxes? He's already there's been a firing of a Treasury official over recent days, so it's been a busy time already. Financial services regulation could be in focus, and we hear from the Bank of England, of course, on Thursday. So lots to talk about when it comes to the UK and its economy. That is it for the early edition. More surveillance is ahead. They will be hearing from Anna Han of Wells Fargo. Lots more conversations still to come. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people.
I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
We're definitely seeing resilience in the U.S. economy. The labor market's still strong.
I think Powell, as usual, is going to wind up having to let some of his inner Doug come out.
Fed policies showing up in full force already.
Trying to sort of engineer the soft landing, I think, is a very delicate dance.
I think we've probably not seen the worst of it yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Yields are up, stocks are down, Tom's on a plane somewhere. All is right in Lisa's world. Live from New York City this morning.
You're going to pin that on me?
Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK on his way back from London. He'll be back with us for Fed Decision Day. Futures lower by 0.4%. Lisa, in this bond market, it's headline after headline after headline.
Yeah, well, right now I'm just looking at that two-year yield. And last week, Tom was asking, when are we on 4% watch? And I suggested that we were on it, and we are definitely there. I mean, this idea that we're at the highest level for the two-year yield going back to 2007, headed to 4%, how does that upend a lot of projections of valuations?
It's how quickly it's happened as well, Lisa. 12 months ago, the two-year yield, the nominal yield, 22 basis points 12 months ago. What a move we've seen in the last 12 months, never mind the last couple of months as well.
So it's poised for the biggest annual increase in that benchmark two-year rate going back to 1994. But we're actually poised, if we continue at this pace, to exceed that. How do we then reprice everything else? And you say all is right with the world. I'm not sure if you're talking about Tom on a plane or not talking
all
about
is right
yields
in your world
or talking about bond or stocks being down. But all is right still in Marko Klanovic's world because he is still bullish. So, I mean, I'm just saying that everybody kind of can take something home that
you mentioned the man from JP Morgan. He's no longer talking about upside. In his recent note, he was talking about limited downside. Here was the lead quote: robust earnings, low investor positioning, and well-anchored long-term inflation expectations should mitigate any downside in risk assets from here. Can we take the first phrase, robust earnings? What do you make of the earnings front now? FedEx last week, Ford overnight.
Yeah, that's what I was going to say. Right now, what we're hearing from companies is a little less sanguine than what he's putting out there. Ford saying that they're going to take a $1 billion hit on production costs because of inflationary pressures and talking about thousands of vehicles that they can't finish because of supply chain disruptions. I mean, the number of companies that are coming out with warnings that people were not expecting kind of feeds more into the Mike Wilson view of things than the Marko Klanovic world.
The earnings worry and maybe the rate shot's not finished. Real yields on a 10-year. The highest since going back to 2011 this morning. Lisa, that's where your competition comes from now for the equity market and elsewhere.
Well phrased. That's the issue. Is all of a sudden you can get yield. There is an alternative. At what point do people say, I'd rather get a 4% base rate and just know I'm going to get that than go into risk assets? And how much does that continue to confirm the JP Morgan asset management view? It's interesting how different they are. That basically has 70% in cash.
I'll catch up with Bob Michael as well a little bit later. Looking forward to doing that this morning. Both nominal and real yields at the highs of the year, multi-year highs, in fact, across several maturities. Futures negative about 0.5%. I'll whip through the price action for you. On the Nasdaq, we're down about 76. We're down 0.6%. Talked a lot about how much higher yields are by 4 or 5 basis points on a 10-year nominal yield, 350, 356. And euro dollar, Lisa, just about holding on to parity. Again, we're negative 0.2% on the day.
I'm watching the Japanese yen, too, because tomorrow starts the Bank of Japan meeting, and that's the one holdout in the negative yield universe as everyone else continues to raise rates. Today, we're watching 8:30 a.m. August housing starts and building permits, and this builds on what we saw yesterday in terms of home builder sentiment. Just to give you some perspective, we have seen the longest consecutive streak of declines in home builder sentiment going back to 1986, giving you a sense of just how much pain you're seeing in the housing market. This is one of the most direct hits from the higher rates by the Federal Reserve. At what point does this feed into pricing? At what point does this feed into rental costs? And how quickly is that transmission mechanism at a time when that's still adding to the headline CPI? Today is the beginning of the 2-day FOMC meeting. I have been watching that 2-year yield. It's shocking. I mean, just the pace of increase. We have increased by more than 3 percentage points so far year to date, and that puts you on pace for the biggest increases we were talking about going back to 1994. But really, how much does this reset risk expectations? This is what we've been talking about all along, and how much are we getting some gleaning from that with respect to Ford, with respect to FedEx, with respect to some of the others that have come out and issued some warnings. And today, President Biden is traveling to New York City. Watch out for traffic, obviously. Democratic National Convention reception tonight. Tomorrow, he's giving a speech to the UN General Assembly. And, John, it's going to be really interesting to see, first of all, after a CBS interview with Face the Nation interview where he was talking about Taiwan, how much has he really bought into this polarized allied groups, right? This whole China, Russia versus the U.S. and Europe. How do you sort of reassociate a world post-pandemic, post some of the fissures that we've seen over the past 24 months?
That is such a New York complaint, and I am so on board.
Yeah.
I hate it.
Come on,
I
it's
hate
awful.
it.
You could already see the streets blocked off. You can't even
move.
walk across the street.
You can't move.
It's ridiculous.
We should just stay at home.
Just stay at home.
Let Tom do the show tomorrow.
Okay.
Fed special. Just
I'm
stay
game.
at home. Ramo, thank you. Futures down about 0.5%. Such a New York complaint, but honestly, if you were here, the traffic's terrible. Greg Battle, US Head of Equity and Derivative Strategy at BNP Paribas, couldn't make it to the studio because the traffic's so bad. Greg, let's talk about this market and how competitive these real yields are with the rest of the market.
Yeah, good morning. I think the first half of this year has very much been a story of this huge repricing that you've talked about in the rate complex, and what that's done to equity valuations. It's driven a massive compression in PE multiples. Looking ahead to the FOMC, 75 basis points, 100 basis points, whatever we may get. Our house view is 75. But we're going to see tightening through the back end of the year, into the middle of next year, and then quantitative tightening, QT, continues in the background, and it's going to be a very difficult environment for equity PE multiples to expand. Instead, contraction or continued contraction.
Is that the pocket of market that you think still needs to reprice based on the rate shock we've witnessed this year?
Yeah, I think the problem that we have for equities is that we have two twin headwinds now. One is the repricing in PE multiples driven by the monetary policy environment. And the second now is the cyclical headwinds that you were both talking about earlier in terms of corporate earnings. The estimates for next year to us still look too high. We're seeing some of these warnings come through. We're going to get into earnings season in the middle of October, and we expect to see some more. So there's kind of two twin headwinds. The valuation complex we think is going to put pressure on growth, but you also have to be very careful about some of the more cyclical stocks as we have this rapid economic deceleration.
So, Greg, everyone seems to be bearish. How much more downside is there, or has this all been baked in?
Yeah, so we take a little bit more of a neutral view on markets. The piece that we published at the start of last week was called Carry On Trading Ranges. And the theme to this is that we still think we can get some really choppy moves. We've had a couple of 3-4% days around the CPI in Jackson Hole recently. And we think that type of volatility can continue. But we think maybe it happens in a little bit more of a range. That may be a wider range than we've been accustomed to previously. But we don't think we're going to trade back up through those kind of lofty highs we got to in mid-August, 4,300, where the market looked overbought or overvalued. But we're also not convinced that the data is going to be bad enough that it's going to take us down through new lows for the back end of the year.
When you say the data, are you talking about the macroeconomic data, or are you talking about the earnings reports that we get from some of these companies as they give profit warnings, but also are dealing with a still resilient consumer?
Yeah, I think that's a good question. Obviously, the two go hand in hand, but really it's the corporate earnings that we're focused on. I think we've had a view all year that the consensus bottom-up forecast for earnings have been a little bit optimistic. And when we talk to our client base, kind of institutional managers, hedge funds, asset managers, there's really been this consensus that the numbers that we see, the published numbers on the street, look too high. As we look to 2023, and we think the focus is going to be more on next year's earnings at this point than this year, the outlook, the guidance that corporates give, we just think the expectations for flat margins year on year and still healthy top-line growth are too optimistic. So the street is looking for around 244. We think it's too high. We could get something closer to mid-230s. If you believe we're going to get a bit more margin compression, a bit more of a difficult environment, you could easily get a lower number than that.
Did you see the PPI numbers out of Germany this morning, Lisa? These numbers are incredible. Factory output prices up 45.8% in August from a year earlier, up from 37.2% in June. And of course, you know the main drivers here, electricity and gas, up 24% from a month earlier, up 167.8% from August last year. The damage done to Europe, Lisa, do you think we've fully realised the damage done, that will be done, to the continent in the months ahead?
80% of people in a recent survey said that Europe is headed for recession. Everyone seems to be saying that, and you have BlackRock coming out and saying absolutely is not priced in to European equities. I would take it a step further, because not only do you see an dramatic increase in inflation, but you're hearing around the continent about different companies closing production because they cannot afford the cost of it, idling their factories because they just cannot afford the output.
Greg, how do you price this messy winter that Europe's about to go through?
It's incredibly difficult to price. We're going to have a very difficult winter in Europe, and I think, fortunately, at least in the US, we have some relative resilience to that. But I think in terms of valuation multiples and trying to put a number on it, I think is maybe the wrong way to do it. When we go back and look at equity markets historically, we find that markets are much more driven directionally by what's happening in terms of the incremental bits of data. When news flow and data gets a lot worse, the market tends to trade lower, and vice versa. There doesn't tend to be a single number in terms of valuation that implies a trough. So in terms of the outlook for Europe, what we'd be looking for is some kind of incremental improvement in the data, or perhaps the data starting to get worse at a lower pace rather than valuations. Europe has been cheap and under-owned for a long time, and we don't think that alone is going to be sufficient to trigger a European rally.
That's how low the bar is, getting worse at a slower pace. Greg Powell of BNP Paribas. That's the hope. That's the hope. And it's always about that, Lisa. Let's be clear about it. Jokes aside. It's never about good versus bad. It's about better versus worse. Are things getting worse? And if they're getting worse, are they getting worse at a pace you expected them to be getting worse at?
Yeah, okay. That said, they're still getting worse. And a lot of people are saying that there's not exactly a reason to go into European equities. Just extrapolating out, have people really fully understood the ramifications of a Europe on its back, really for the United States, right? For some of these other nations. I just wonder how much you can price in a global slowdown to the extent that you see that stagflationary kinds of prints out of Germany, how that bleeds into the global backdrop.
And they're tightening into it. 75 basis points from the ECB last week. In fact, the week before. My whole mind's kind of muddled right now.
This week didn't count.
Was it the week before that? Anyway, whatever. September 8th, I believe it was. And then you've got the Riksbank out this morning, 100 basis points. Bang.
Yeah, raising rates the most going back more than 3 decades. Does this really actually make a difference for the Federal Reserve? Some people saying that it's more likely now that they're going to raise by 1 percentage point, that they're going to be led by the Riksbank in Sweden. I'm not sure that
Sweden
I'm buying
sets
that.
the tone for Chairman Powell.
Exactly. And they're late. I mean, this is like they're actually way behind some of the others.
Anna Hand's going to weigh in on some of this, not on the Riksbank, on the equity market.
Maybe she will. I don't know.
I want to.
She's got strong feelings.
From Wells Fargo at 7 a.m. Eastern Time, so 50 minutes away. AMH is in the studio. She had a really important conversation with the Ukrainian foreign minister. We'll break down some of that for you next. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers today begin a 2-day meeting that's expected to end with another jumbo interest rate hike. According to economists surveyed by Bloomberg, the Fed will hike its benchmark interest rate by 0.75 of a percentage point for the 3rd straight time. Chair Jerome Powell has made it clear the Fed is committed to curbing inflation sooner rather than later. And in Japan, inflation has accelerated to the fastest pace in more than 3 decades. That creates headaches for the Bank of Japan. We will try to explain why it needs to continue with monetary stimulus when inflation is above its 2% goal. Consumer prices, excluding fresh food, rose 2.8% in August from a year ago. Britain's new Prime Minister Liz Truss says that a trade deal between the U.S., UK, and the U.S. is unlikely in the short to medium term. She says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting of the UN General Assembly. Hong Kong wants to relax its COVID rules, like mandatory hotel quarantines that have made travel difficult since 2020. That's according to the city's chief executive, John Lee. The South China Morning Post reports that quarantine will be replaced with 7 days of home health monitoring. Officials in mainland China appear to support the changes to make Hong Kong more competitive. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics' power players. Weekdays, this is Bloomberg. All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it. Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
Fantastic conversation with Dmytro Kuleba there, the Ukraine foreign minister, with Bloomberg's Anne-Marie Hordern. Live from New York City this morning. Good morning. Alongside Lisa Abramovich, I'm Jonathan Ferro. Futures down 0.5% on the S&P. On the Nasdaq 100, we're down 0.6%. Yields higher again, up by 5 basis points, 350, 395, going into the Fed tomorrow afternoon. Bramo, are you excited or what to catch up with the former Vice Chair, Richard Clarida?
Do we get the real goods, right? I mean, not to say that
The
they're not
the
necessarily
unscripted
doing
version?
that. Exactly, the unscripted
You
version of what
want the
happens.
Bill Dudley-esque, I've left the Fed and I'm going to speak my mind?
Wouldn't it have been nice if we could have them together and just basically hash out, what is the reality versus what's put out there? The sort of very sanitized speech that Jay Powell comes out and gives, and sort of the wrangling behind the scenes, the angst, yeah.
You don't want the sanitized Clarida just after the decision. And then after the news conference as well, he's going to hang out with us and
I can't wait.
give us his thoughts on that. Looking forward to it. And TK is going to be back in the building as well, I'm told. Today's a travel day, so he's in the sky somewhere. Do we know when he left? I've got no idea when he left or when he arrives.
I think maybe he was going to get in another Tots game.
I'm just told he's going to make it. Futures are down about 0.5% on the S&P. The latest headline on the UN General Assembly, here you go. The EU Commission President Ursula von der Leyen to meet the UK Prime Minister Liz Truss in New York tomorrow. So busy day tomorrow, Lisa, that's for sure, here in New York City.
Yeah, I'm wanting to hide, maybe. I think it's going to be really rough, I've got to be honest. I'm curious to hear what that conversation's like. Liz Truss, all of a sudden, she's really facing the firing squad, at least rhetorically, because her policies are incredibly controversial and they're absolutely decimating the value of the pound.
Anne-Marie is responsible for the busy roads here in New York City. She's back out from D.C. She's with us now, Washington correspondent. MH, can I just start with that brilliant interview you conducted yesterday with the Ukrainian foreign minister? Things are tough in Europe. They're getting harder. Certainly not as hard as they are in Ukraine with the war ongoing. Did you get the sense from him that he's confident that resolve on the continent is going to hold through a tough winter?
He is very much so confident, and he thinks that Europe understands the crisis, and not just because of the war that's happening on their doorstep in Ukraine, but, he points to the fact that even before this war started on February 24th, you already saw natural gas and oil prices start to spike. And already he says Putin was starting to play politics with energy, and he has done so in the past. So he believes that Europe will maintain this resolve because really they also do not have a choice. But it's going to be incredibly difficult. What's in the New York Times today? The fact that you see factories starting to shut down overnight. Germany is extending credit lines so they could shore up some more LNG. It is going to be incredibly difficult and incredibly painful for Europe. And that's really the big question going into this UN meeting. It's really the sideline meetings that matter. And so much of that is going to be about what's going on in Ukraine. Are they going to get the more weapons they need and the ammunition they need, that surplus to continue on the heels of this counteroffensive that was successful? And also, is Europe going to be able to maintain this unity in the fact that they are really feeling the blunt of this in their own economies at home?
And there's another way to put this as well, Anne-Marie, is this UN General Assembly meeting, basically an issue about energy and how to shore up enough of it to keep Europe in a decent situation or not flat on its back over the winter season. How much is there a realization that this is getting desperate, and moves like the U.S. opening up their Strategic Petroleum Reserve through November possibly going to help this?
Well, what the U.S. is trying to do is make sure they can quell oil and natural gas prices, because they have also another issue, right? This is also the midterm elections, and this is a huge domestic issue, or was in the summer, and is starting to quell a little bit, but you're sure the Biden administration wants to make sure they are keeping prices and a lid on those prices going into the midterm elections. For the U.S., obviously, the big sticker price is gasoline when you fill up your tanks, and what that means for supply chains and the cost that means for food, et cetera, but also electricity bills. And this is really the big issue in Europe. Electricity bills, obviously, that it has to go and mirrors natural gas prices. I put this stat to Dimitro Kuleba yesterday. In Germany over the summer, you had electricity forward prices 1,050 euros per megawatt an hour. Do you know what it is at an average? About 45 euros. This is the desperation Europe is going to see, and it's only September right now. I think Jonathan said the other day, what we really need is a meteorologist, because depending on how cold this winter is going to be, that's really going to affect how Europe is able to deal with this crisis.
Anne-Marie, with the tenor of your conversations around these meetings, how much do people think that Europe has recognized, European policymakers have recognized the situation that they're facing?
I think they have deeply recognized it, right? They know that they are no longer going to be able to rely on Russian natural gas anymore. It was last summer that Angela Merkel was at the White House, and they were still talking about Nord Stream 2, and this is something she wanted to see. Nord Stream 2, we're never going to see that come online, and now we're not even seeing natural gas through Nord Stream 1. You have the entire European situation starting to have different discussions with partners that they normally never would have, or making more trips to those partners that they normally never would have. The likes of Algeria, the likes of Qatar. These are really important conversations, because these are countries that can potentially come and help Europe in this dire winter, because they have liquefied natural gas. But that's just this winter. Europe needs to change its infrastructure in order to be able to handle not just this winter, but the winters to come. Germany specifically, they shut down nuclear. They're potentially going to keep some of those more open longer. And also they're building LNG terminals. This is a complete tectonic shift in how Europe deals and imports its energy.
Speaking of the temperature, can you tell me how frosty that meeting between the President and the British Prime Minister will be tomorrow?
Well, it's going to be an interesting one. Already we heard from the new Prime Minister, Liz Truss, on her plane over that she doesn't see a short-term, medium-term trade deal with the United States. John, you know better than anyone that this was a key issue for those Brexiteers to go out and vote. This was supposed to be one of the hallmark wins of Brexit. We're going to get a huge trade deal with the United States. That's not happening. When you talk about the frostiness, though, that's going to come would have to do with Northern Ireland. And obviously, President Biden, like many Americans that have Irish ancestry, really want to make sure that Good Friday Agreement stays in place. So potentially this is going to be a thorny one. And I wasn't so sure if the president was going to meet her on the sidelines, but they will have that meeting.
Can I finish on a much, much less serious point? Can we stop calling it UNGA? UNGA. I've never liked that.
By the way,
UN
I'm
General
taking the
Assembly.
subway
I've
because
never liked that.
the streets are way too busy.
Does my head in. UNGA.
UNGA.
I just never liked it.
You mean
at
you
all.
don't like saying it? It's kind of fun to say, don't you think?
it.
Why? It just sounds like a chant. Unga,
No, just,
unga,
I
unga.
just...
Yeah, all right,
I
so
don't know.
you know, just letting you know, you're ranting. I have not called it unga all day,
I'm
but
with
now
you.
I think I might.
Do what
It's
you
kind
want.
of fun.
What do you make of AMH on a subway in New York? Just skipping the
I
roads.
said I was making traffic.
I think that was her calling us elitist car users.
I think
was
that
was
you're calling
that
us
where you were
this.
going?
I was looking for a rim shot, talking about the weather. How about those frosty relationships between?
I thought it was really good.
It was classy.
Nice. From New York. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Live from New York City this morning. Good morning. Here's the price action for you in the equity market on the S&P, on the Nasdaq, on a Russell. On the S&P, we're down 0.4%. On the Nasdaq, we're down about 0.5%. The small caps a little lighter, softer, lower, negative 0.4% as well. The poison comes from the bond market. The two-year yield is up for, I think, a 9th straight session now. Just absolutely flying over the last couple of weeks. A two-year approaching 4% at 397.07, up 3 basis points. Remember all the calls on this show? We've seen the high of the year. We've seen the high in the year. That was back on June 14th on a 10-year. Maybe we haven't. Here's the high of the year, 353.56, up another 4 or 5 basis points on a 10-year. And just to witness, understand the scale of change we've seen on a two-year yield over the last 12 months. 12 months ago, that two-year was up about to 21 basis points, 22 basis points. Look at this turnaround. Through the valley and up the other side in a big, big way.
I love this phrase that you just said. The poison comes from the bond market. It sounds like a horror movie. You know, it's kind of like coming in, creeping in, toxic brew, because the poison. It's true, though, because this is really what's causing a complete reset in people's understanding of where to get value. If you can actually get income without taking extreme risk at a time of great uncertainty, well, it doesn't look so bad.
And real yields as well, not just nominal. Real yields the highest since 2011 on a 10-year maturity. Lisa, these are big changes, and they're happening very, very quickly.
Maybe the bulls could say 1% real yield, whoopee, right? You could actually get some real yield if you actually take some risk. But nonetheless, it completely transforms the risk-reward proposition. And you're hearing that from the likes of JP Morgan Asset Management when they say 70% in all liquid.
So someone got in touch with me a little bit earlier this morning, and they said, I remember a conversation I had with you. It was at the start of the year, and dollar yen was at 115, and I said it could go to 150, and you laughed at me. So we need to ask them why it hasn't made it to 150. Christopher Ryan, partner at Head of Technical and Macro Strategist at Chatigas, a Baird company. Great call, Chris. I mean, we're so close at 143. I think we came even closer than that. Where next, I guess, and does the BOJ blink?
Yeah. Well, I think they have to. I mean, when you look at yields around the world, U.S. 10s, as we mentioned, are 3.53 this morning. German 10s are basically 2%. We've seen UK 10s absolutely run away. And we sit here, and Japanese 10-year yields are 26 basis points. I'm just not sure how much longer the BOJ can sustain this cap on yield without losing total control of the yen. So we like dollar yen higher until, frankly, someone breaks, and I think that's the BOJ. So whether that's 150 or 155 or some other level, I think we're on a collision course here that ends with BOJ capitulating, raising the cap on yields to get more in step with what we're seeing around the world.
Chris, have you thought much about how the dominoes fall from there? If that headline dropped, that they stepped away from yield curve control, what it means for bonds, what it means for treasuries?
I mean, I think the initial reaction is maybe you get your blow off in yield, but our experience just has been, I think the historical experience has been bond yields tend to go up until something breaks. And that's why I just don't think that we're done here yet on yields. Our view on yields has simply been they're going to remain stickier and higher than the consensus believes until there's an accident. And I'm not convinced we've quite seen that accident yet.
And the accident comes with longer-term yields rising in addition to short-term yields, possibly what you're talking about with the yield curve control being abandoned in the Bank of Japan and the ripple effects through the rest of the world. What kind of downside are you looking at? How do you sort of hedge against that scenario at a time when it could take a lot longer than people could afford to keep that position on?
Well, I think it just speaks to our overall positioning here, which is play small, go slow, be prudent. Caution is still the word of the day. And, where you really see, at least, the impact of yields is on what the leadership framework of this market looks like. You have yields up and utilities continue to dominate. So I look at that as a very late cycle message. When you look at the top of the market, the big stocks, the big weights, the one everyone owns, right? A lot of those are already below where they were in June, whether it's Google or whether it's Microsoft. So, you see the impact of yields continuing to hit tech. And I think that's going to remain the story until yields peak, which I just don't think is here.
So when you look out to what's going to happen in the next couple of months, what I'm wrapping my head around is what's the downside here, right? I mean, an accident, how does that ripple through a market when people are saying there isn't the same kind of leverage? You're not seeing the fragility in banks. You have a much more stable base of consumers and their savings and corporate savings. So that's the reason why you have this bid, you have this range. What's going to break that? Will anything, or is that still going to be the reality?
I think that's unclear. The narrative or the consensus is that there's no risk to banks or that consumers are in better shape than we've seen. But I'm going to let the market be the judge of that. When I look kind of at different pockets around the world, I could show you plenty of weak consumer stocks that would suggest that the market might have a very different opinion of that, or plenty of weak bank stocks that would suggest the market has a different opinion of that. So we let the market kind of dictate that. What I think is most important for investors is, the debate on the street is, okay, is S&P going to, revisit or retest or undercut the June lows? And the only thing I would add to that conversation is a lot of important stocks already have, right? When we talk about the top of the market, Microsoft has, Google has, Meta is back to where it was at the COVID lows, right? So kind of go down the line, and a lot of big names, a lot of big weights have already, I think, started to reflect that risk.
Chris, lost decades aren't unheard of. You given much thought to that at all recently when it comes to the US equity market?
It's funny that you mentioned it, Jonathan. Earlier in the year, we wrote something to the effect of, the most provocative thing we could say is not that the S&P is going to go a ton lower, because I think everyone was pretty bearish, but that the S&P is not going to make much progress for a long period of time. And that's a view that we've kind of embraced here as you kind of make this transition from QE to QT. I think at a minimum, when you look at the very liquidity sensitive assets out there, new IPOs, Bitcoin, high multiple software stocks, I think those things are done as your leadership for a very, very long time. That's been our view. That remains our view. So I think when you look at those, very speculative corners of the market, they are saying, even if the S&P lows are in here, there is no new liquidity cycle in front of us.
The reason I bring this up, and I imagine it's the reason you're thinking about it too, is that we've just blown up a decade of QE forever and ZERB. Yeah. And I just struggle, Chris, and we're all living this in real time, I just struggle to understand why 12 months of raising interest rates and doing a bit of QT, and then we go back to where we were before. These are big moves. It's not just the Fed. It seems to be pretty much everyone, with the exception of, say, the BOJ. I mean, why would it take just 12 months to reverse 10 years of that, and then the consequences are, oh, yeah, we just go back to the old playbook in about 6-9 months?
Jenna, I'm with you. I think to kind of maybe use a little bit of a cliche, this does look and feel like regime change. I think the one chart or the one exhibit that speaks to that, it's on the Bloomberg terminal, is that dollar value of negative yielding debt. We went from $18 trillion of negative yielding debt as recently as a year ago. It's down to about $1 trillion today. So if you're looking for regime change, I think there's no better exhibit of it than that.
Is this a regime change when it comes to nominal yield, or is this a regime change when it comes to real yield? Are we going to see real yields continue to climb as people price in a very different response from central banks?
Well, it's both, and I think the thing about real yields, right? It's it's somewhat fashionable to say that real yields are positive or that real yields are above 1%, but not really. I mean, the Fed funds rate is still well below the rate of inflation. So in any practical sense for savers, real yields are not positive here yet. So I think ultimately, as we've seen in every single cycle going back to the last 50 years, the Fed funds rate will overcome the rate of inflation. That's when the Fed has done enough. And I think there's certainly time before we get there, Lisa.
Are people positioned for what you're expecting, Chris, this sort of accident or something breaking?
No, I think, when you look at what positioning looks like, there is a decade of residual positioning at the top of the market, the big weights that have been so reliable for so long. And kind of our view is, again, whether it's market up or market down, that's actually less important. What's more important here is this massive leadership change that we've seen. I'm very reminded of in 2002, when the NASDAQ bottomed in October of 2002, right? It bottomed with everything in October of 2002. It continued to underperform for the next 4 years. So your price low in NASDAQ, I don't think will be your price low in relative performance. That is the big takeaway from us. The leadership picture has changed dramatically here.
Interesting. Hey, Chris, great call on the yen, buddy. And I'm sorry for laughing.
Thank you.
I'll never laugh again. I will. Chris Ferrine, a strategist.
I was going to say.
Of course I will. Still not at 150. What's Chris been doing?
Yeah, exactly,
What's
clearly.
he been doing? That call was
You're right.
terrible. It's a great call. The other thing we need to talk about that Chris mentioned, we've just had a 10-year-long monetary policy experiment. Trillions of dollars of QE, zero rates forever, negative interest rates of the ECB for about 8 years. Trillions in negative yielding debt, Lisa, that you used to come on and bring a chart and tally it up every single time. Not just sovereigns, but corporate debt as well. And are we to believe that after 10 years of that, and when you blow it up, there aren't big consequences from that last a little longer than a couple of quarters?
Especially because of the why, which is inflation that people said wasn't possible, right? I mean, do you remember during that decade, people said inflation was dead. You couldn't get it out. That was what gave rise to this whole modern monetary theory, that you could just print money and it wouldn't cause inflation because nothing could cause inflation. Inflation was dead in this era of low growth and older populations, and this is what was going to happen, and it was wrong. And it was wrong on multiple levels. And how do we then reset at a time when there still is the resilience built up over that decade of free money? And this is something very difficult to really game out, given the concentrated and concerted effort globally from central banks.
Something we'll keep building on this morning. And forgive my rant about the traffic in New York City. Do you want to know why I'm really fired up this morning about it? Yesterday, I was in an Uber, and he was getting angry about the traffic.
Yeah.
I log onto the Uber app this morning.
Well, as you can see, the extractor fan stopped working. It doesn't
because he
suck
was angry
any.
about the traffic. I wasn't angry at all.
Are you sure
I
that
said,
was the
thank you, sir.
reason?
I went from 4.95 to 4.94.
You didn't rant about the yen or tell him that
No
his
rants
call
at
was
all.
bad?
I was very
Laugh?
quiet, peaceful. I'm a great passenger.
Ask him, Unga?
I'm a fantastic
Do you
passenger.
say Unga or United
Cut
Nations?
me from
General
4.95
Assembly?
to 4.94.
Do you quote the Dow?
4.94
Maybe
is
he
still
likes
very
the
good,
Dow.
by the way.
By the way.
By the way,
Keep telling
just so
yourself
you
that.
know. No, it is.
Keep
It's
telling
that's
yourself
a
that.
very
That's
good rating.
Anne-Marie writes
It's a very
in,
good rating.
Take the subway in all caps. I think that she's trying to
I'm
message
supporting the cab drivers of New York City.
Yes.
Seriously.
Thank you for your service,
Coming
Mr.
up,
Farrow.
Ellen Wald, Senior Fellow at the Atlantic Council from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The foreign minister of Ukraine is urging the West to send more weapons. Dmytro Kuleba told Bloomberg TV that Ukraine wants to add to its recent territorial gains and deny Russian forces any strategic advantage. Kuleba says it makes sense to supply Ukraine because it can defeat Vladimir Putin and his army. In Switzerland, the government has slashed its forecast for economic growth and significantly boosted its projection for inflation. Swiss GDP